One cigarette will cost you 20 rupees.
So now are you able to see? So the question is, when we have got GSTR1, GSTR EV, why another return, GSTR9? If you recall, or in case, VAT regime, so what was a monthly return, was an option, compile annual return. So this annual return has to be physically signed. It will be collated in the portal, but it has to be physically signed by the dealer and has to be submitted with the authorities. The reason why under VAT regime this annual return was being introduced is that the authorities, when they do the assessment, it is for full 1 year. So therefore, they wanted to compile the information so that they will be able to compare with the financial statement. So that is the reason there is a requirement to file the GSTR 9. Another important aspect that we need to take into consideration here is that it is the consolidation of all the monthly returns. It is a consolidation of all the monthly returns. It is GSTR 1, 3B. And GSTR 1 and 3B for the financial year must be filed before we file. It is a prerequisite that all the returns for the year has to be filed. What is this GSTR 9? Consists of sales turnover, input tax credit, other details like refund claimed, refund rejected, demand raised. So all these things along with HSN, all these things will be covered in the GSTR 9 returns. Is the purpose satisfied with regard to Sana, are you able to see the screen?
Yes, sir.
It is moving, no?
Actually, no, it is stuck in the first page, GSTR 9 annual filing. Yeah, now it's visible.
One minute.
I'm doing no appointment.
What way it is going to help the authority? It will help the departmental authority in reconciliation.
So now, all good, sir?
How are you to see this thing? Hello, Sana. Are you able to hear now?
Now I am able to hear.
Should I start once again in case if audiences are finding it difficult, in following it?
Just a few slides back, you can actually start, sir. They were following actually. I think from slide 2 they missed it. So,
Okay.
or you can continue with the present slide.
Okay.
Yes, sir. Yes, sir.
Thank you. So as I mentioned, this GSTR 9 is going to help department in reconciliation in the returns. You see the returns, it is a monthly return. And also it is a self-assessment. Every time when we file the return, it is deemed as it is a self-assessed until and unless there is a notice from the department for carrying out the verification of the returns or any order is being passed. So once GSTR 9 is filed, it cannot be revised. So therefore, you have to be very careful while filing GSTR 9. The reason why it is important here is that whatever the GSTR 9 is being filed, that will be taken for the purpose of assessment. In case if GSTR 9 filed is erroneous or there is a mistake which is been there, then the department may invoke section 74 instead of 73, that is suppression of information fraud. And therefore, there will be a enhanced levy of penalty on the assessees. So therefore, it is very important for us to ensure that there are no errors in the GSTR 9, what we are filing. Now, this GSTR 9 is to be filed for every GSTN, even if it has got a nil turnover. Just to give a couple of examples. Now, we have got a entity which has got two branches. That is one in Karnataka, another one in Tamil Nadu. In Karnataka, there is a turnover of say 10 crore. In Tamil Nadu, there is no turnover. At for the Tamil Nadu locations, we have to file GSTR 9. So kindly ensure that when you check the number of distinct entities, once if GSTR 9 is applicable to any of the entities, then it is applicable for other entities also. Kindly file the returns even if it is nil return. Otherwise, there will be a penalty which will be levied. We will see in the coming slides. This annual return is a last chance for rectification of mistake. Sometimes, as we are aware that GSTR 1, GSTR 3B, we don't have an option to revise the return. Only we can make necessary changes in the subsequent months by way of an amendment. So therefore, in case if those rectifications could not be made till the specified date, kindly ensure that it is been properly disclosed in annual return so that you can safeguard or overcome from the provisions of section 74 and you can be assessed under section 73, which will enable you to lesser penalty. Now, who should file GSTR 9? Annual return is mandatory to be filed if the aggregate turnover is more than 2 crores. So up to 2021, so it was an optional. Post that it is exempted in case if the aggregate turnover does not exceed 2 crores. We will see it in the coming slide. Now the question arises, in case if the turnover is less than 2 crore, can we not file the GSTR 9, or is there any scenarios where we have to file even if the turnover is less than 2 crore? The answer to this question is that wherever the auto-populated GSTR 9 is not matching with the books of account, then in that case, you have to ensure that GSTR 9 is filed so that the errors and omissions can be rectified by way of GSTR 9. What is the returns in which GSTR 9 has to be filed? There are different persons who are required to file different GSTR 9 returns. So in case of registered person, is GSTR 9. For composition taxpayer, it is GSTR 9A. For e-commerce operator, it is GSTR 9B. As I told that, this previously up to the financial year 2021, it was optional. Post 2021, it is exempted. That is for the financial year 21-22, it is exempted in case if the turnover is less than 2 crore. So previously, they could have opted to file the GSTR 9 voluntarily. But after that, there is no requirement. As I told, in case if there are any error or omission, then in that case, it can be rectified by filing GSTR 9, even though the turnover is less than 2 crore. This needs to be kept in mind. Now the question arises whether all the registered taxpayer is required to file GSTR 9, or are there any exception from filing GSTR 9 for any registered person? So as you can see from the slide, following category of registered persons are not required to file GSTR 9. Who are those? One is casual taxable person, in service distributor, non-resident taxable person, person paying TDS and TCS, and OIDR service providers who is situated outside India and they are registered in India. Also, the central government, state government, or local authority whose books of accounts are audited by a Comptroller and Auditor General of India, or are treated any other law for the time being in force. So these are the registered.
Hello, sir. You're not audible, sir.
No, Sana, now are you able to hear?
Yes, sir. Better, sir.
Yeah.
Fine.
Thank you. So the following persons are not required to file their GSTR 9. So what is the due date to file GSTR 9? As we are all aware that 31st December of the subsequent financial year is the due date. Now for the financial year 22-23, 31st of December 23 is the due date within which GSTR 9 has to be filed. Now, what if the GSTR 9 is not filed within the due date? Now, the late filing fee is, in case if the aggregate turnover is up to 5 crore, it is rupees 50 per day, or 0.04% of the turnover in the state or union territory. This is the maximum amount, which will be a penalty for non-filing of the returns. Now they have bifurcated the turnover up to 5 crores, between 5 crores and 20 crores, and about 20 crores. So in case if the turnover is between 5 crores to 20 crores, the late filing fee is rupees 100 per day, or 0.04% of the turnover. This is the maximum amount. In case if the turnover is more than 20 crore, then in that case, it is 200 per day, which was previously existing prior to the amendment, or it is 0.5% of the turnover in the state or union territory. Now the question arises is that, is GSTR 9 required in case GST registration was cancelled before 31st of March? The answer is yes. In case if every registered person is required to file GSTR 9, even if he is not registered as on 31st of March. What does it mean? He was registered taxpayer during the financial year. If he was a registered taxpayer during the financial year, and subsequently he has applied for surrender of the GST, then in that case, he has to file GSTR 9. Similarly, if somebody has applied for the cancellation of registration, but his application is pending as on 31st of March, he needs to file GSTR 9. So kindly ensure that if any application is being filed, but it has not been, order has not been passed for, cancellation of registration, then in that case, GSTR 9 has to be filed. Before we go into the prerequisite, that is with regard to the documentary evidences, I would like to, bring to your kind attention certain things. When the departmental authorities take up any case for audit, they need to compare the GSTR 9 and 9C, the returns along with financial statement. So therefore, when we are taking into consideration the assignment of GSTR 9 filing, we need to have the following documentary evidences. One is audited financial statement, along with notes, schedules, etc. So here we need to take into consideration the director's report, auditor's report, and also take note of any of the observation. Sometimes there might be a situation that the directors have taken a call to discontinue the businesses, in the short run. What I mean to say here is that they have taken a call that they want to discontinue the business. So in those cases, you have to be extra cautious with regard to treatment that is being given in the annual return, GSTR 9C. Because sometimes what happens, they may write off the stock. So ITC reversal, all those things needs to be taken into consideration if it has not been given effect in the books of accounts. Now, bank-wise trial balance. So this is important where you have got a distinct entity. As I have taken the example of Karnataka and Tamil. The authorities are interested in the distinct entity-wise trial balance and financial statement. I have not included the financial statement because many of the entities do not prepare the financial statement branch-wise. At least they will be able to provide the trial balance, which will face the purpose, to defend whatever the GSTR 990 has been filed for a particular location. Further, we need to take into consideration income tax returns along with copy of 20 AS statement. Now the question arises, why income tax return? Under service tax, there was a memorandum of understanding in the service tax authorities and income tax authorities to exchange the information. So the income tax authorities used to exchange the information with regard to IT returns, the service tax authorities, based on which the service tax authorities were able to send notices where the turnover is more than 10 lakh, based on which we're able to recover the taxes from the unregistered persons who have not complied with the provisions of the Finance Act. So this was a kind of a cross verification where the service tax authorities were able to, do.
Sir, again, not audible currently.
Just give me because I'll try to connect with this.
Hello, sir.
Hello. Hello.
Yes, sir, you weren't audible, sir.
Should I repeat this? I'm extremely sorry. I do not know what is happening.
Yes, some 10 seconds or something.
So I'll start from the beginning of this slide.
Sure, sir.
Need to have the following documentary evidences before we start with the assignment of GSTR 9. One is audited financial statement along with notes and schedules with director's report as well as auditor's report. Kindly go through the director's report or the auditor's reports for any adverse comment or observations, which has got an implications on our GSTR 9. Further, kindly call for the trial balance in case if the entity has different distinct entity. The example what I have taken in the initial stages, that is ABC Limited has got two branches, one in Karnataka, another one in Tamil Nadu. So kindly ask for a trial balance branch wise so that that will become a basis for you to prepare GSTR 9 for distinct entity Karnataka as well as Tamil Nadu. Further, you need to ask for the income tax returns with copies of 26A statement. So the question arises, why we need to have income tax returns and copy of 26A statement? There was a memorandum of understanding between Income Tax Department and Service Tax Department for the exchange of information of the assessees which are available with the Income Tax Department with Service Tax Department. In this exercise, the Service Tax Department were able to issue notices to the assessees whose turnover is more than 10 lakhs, but who has not taken the registration, point number one. Point number two, they were able to send notices to assessees whose income as per the income tax return was more when compared to service tax return. They were issuing notices for calling for reconciliation between income tax return and service tax return. Now, in this process, it becomes important to compare the income tax return with 26AS statement and also the ST3 returns. So similarly, the same thing has been extended with GST also. Till today, we were not able to see any such notices, but in the days to come, there will be notices issued when they compare the income tax returns with GST returns. Though that information is already available in the income tax portal 26AS statement, you will be knowing the turnover, GST turnover. Now, the vice versa, they will be, comparing the GST turnover with the income tax turnover. Certainly, will question why the differences between these two returns, and reconciliation has to be provided. So it is essential you to have a reconciliation before you proceed with GSTR 9C. Now we need to have the books of account, either it may be a Tally, QuickBooks or Zoho, whatever is. You need to have access to the books of account. Further, there are other records such as cost records or corporate records, if any. These things are essential because you have to go through these records, and as a template or a checklist, the departmental authorities will ask for these cost records and corporate records in order to find out any other observations which will have an implications on the GST returns. Further, you need to have a GSTN login ID and password, because many a times you need to pull the information from the portal, such as previous year annual return. Now current year GSTR 1 3B. You need to ask for GST 1 3B workings along with the supporting documents.
User ID password GST portal, previous year annual returns, current year GSTR 1. ಏನು ಜೂಮ್ ಮಾಡಿ GSTR ಅದ್ರಾಗೆ ಏನ್ ಮಾಡಿದೆ ಅದ್ರಾಗ ಐತಾ
Talking at the background. Hello.
Yes, sir.
Hello.
Yes, sir.
Are you able to hear, Sanu?
Yes, sir. Now, yes, sir.
We need to download GSTR 1 3B summary report from the portal. And also we have to download GSTR 9 system computed summary. Along with that, we need to have electronic credit ledger, electronic cash ledger, details of refund applications filed, sanctioned, and order passed for any demand raised. Now, we are seeing many notices has been issued to culminate in an order. So those orders also has to be connected with
Sir, you're not audible again, sir.
Now, are you able to hear? Sana, now are you able to hear? Hello.
Sir, your voice is gradually reducing, sir, after every 5 minutes.
Oh. Just but inform me in case if you find any this thing low wise, so that I'll try to connect to another this thing.
Sumitra, you check your internet, no? If that is the case.
Okay.
Not audible, sir.
Sumitra, problem with you, I believe.
Yes, sir.
Hello, Sumitra.
Yes, sir.
I think so. Problem with you. You are not able to hear. You check your internets and all.
No, sir. There are other students. They also told here.
Acha, acha. Videsh, can you please kindly check it out from your side?
Yeah. So internet is okay. There is no issue at all. Now, are you able to hear? Hello. So now we'll see what are the parts of GSTR 9. There are 6 parts, 19 tables, and there are components of table which will give certain informations. Now, with regard to part 1, there are 3 tables which captures basic details. We will see what are those basic details. Now, part 2, which consists of 2 tables, 4 and 5, which will give us the liability turnover as well as the liability for a particular financial year, that is 22-23. Part 3, table 6 to 8, which will give the details or capture the details of ITC. Part 4, table 9, this will capture the details of taxes paid for the financial year 22-23. Part 5, which consists of table 10 to 14, these are all adjustment which has been taken place pertaining to the financial year 22-23, but disclosed in 23-24. So, and the liability, what has been discussed in that. Part 6, from table 15 to 19, which captures other information such as HSN, details of invoices, and other stuffs. Coming to the part 1, that is basic details, financial year, GSTNs, all these things are auto-populated. Legal name, trade name, etc. For legal name and trade name, you have to refer to GSTR registration certificate in which it will be captured. And moreover, it is auto-populated, so no need to take any actions. But only thing is that you need to have a registration certificate as a documentary evidences. Now coming to the subsequent part 2, that is details of outward and inward supplies made during the financial year. Now here in this part, this will capture advances, details of advances, inward and outward supplies made during the year. The important aspect that we need to take into consideration here is whatever the transaction we are capturing in table 4 on which tax should be payable. In the subsequent table, that is table 5, similar transactions on which no tax is being paid. Only those things has to be captured. We will deliberate it when we come to the subsequent slide. So what are the fields that we need to capture here? That is B2B, B2C transaction. Whenever the transaction is with an unregistered person, those information has to be captured here. There are references with regard to R1 table references which has been given here. That is table 5. Table 5, 7, 9A, 9B, 9C and 10 has to be referred for the purpose of filling this B2B, B2C column. Now B2B, we need to refer to table 4A and 4C of R1, that is GSTR 1. Exports with payment of tax. With regard to export, there are two options. One is you can export the goods or services with payment of tax, and another one is with you can utilize the LUT and export as a zero rated supply. So only the transaction on which tax has been paid that has to be reported under clause C. Similarly, SEZ can also be supplied without payment of tax and with payment of tax. Only with payment of tax has to be captured in this table. Now there is a deemed exports. So normally deemed exports are those where the supply is made against advance authorizations, or it may be export promotion capital goods authorizations, or any supply made to an export-oriented unit, or supply of gold against advance authorizations by the bank, are all covered under deemed export. Further, advances on which tax has been paid, but invoices has not been issued, that needs to be captured, and these informations we can refer from table 11A. Now, in case if any advances are there, but on which invoices has been raised, to that extent, it need not be disclosed under column F. I have highlighted column G in red color. This is an inward supply on which tax is paid under RCM. Now, for this, we have to refer to GSTR 3B, 3.1D. The summation of from A to G will be auto-populated in column H. So this will give us the turnover on which tax has to be discharged. Now the subsequent column captures with regard to credit note, debit note, any amendments with regard to positive or it may be negative. All these things will be captured as a individual column wise. The subtotal I to L will be either positive or negative. And in the column N, that is, we will get total supplies and advances on which tax is to be paid. As we have seen that in column A, that is with regard to unregistered person, you have to take into consideration the turnover net of debit and credit notes or amendments. So this is an example. In case if there is a taxable supply made to URP in the month of November, 1 lakh rupees, and if credit note is being issued and also there is an amendment, the net figure has to be keyed in column A. But whereas from column B onwards, the debit note, credit note amendment has to be captured separately and not on a net basis. So this has to be kept in mind. Now coming to table 5. Table 5 deals with outward supply made during the financial year on which tax is not payable. There is an export where you utilize the LUT and make it zero rated. So those transactions will be reported in this table A, and B is with regard to SEZ. Now with regard to C, that is supplies, tax is paid by recipient on the RCM. Just to give an example, in case if an advocate is there and the taxes on which has to be paid by the recipient, that turnover will be captured in column C.
So are you on slide 10?
16. I am at slide 16.
The slide is stuck over here on 10th.
Just 1 minute. I'll stop this thing and then.
Sunny. Maharaja didn't.
So now are you able to see the screen? 16, it is in slide 16.
Yes, sir. Yes, sir.
Okay. As I was referring to with regard to the advocate services on which the tax has to be paid by the recipient, that is, say, for example, ABC Private Limited is there. In case if they avail the services of the advocate, the taxes has to be paid by the ABC. So here the advocate will disclose the turnover under column C. Column D, we have to disclose the turnover which is exempted under GST. And column E is with regard to turnover which is subjected to nil rated tax. Column F, we have to disclose the non-GST supply, which also includes no supply, that is as per Schedule 3 of CGST Act. So there are transactions which has been covered under this. Now, under column G, it is a subtotal of A to F, which is auto-populated. With regard to the credit note from A to F, this field is optional. So either you can show it as net of credit note in the respective field, that is from A to F, or you can show the credit note separately in column number H. Similarly, for debit note, you can show the transaction net of debit note in the respective fields, or it can be shown as a debit note distinctively. But however, it is always advisable to have a details, because when the assessment is being undertaken by the authorities, they ask for the details. They don't go by the informations what is being captured in GSTR 9. For each field, the details has to be provided and documentary evidences has to be given. Similarly, any amendments from A to F, it is optional that it can be captured net of amendments in the respective column, or it can be shown distinctively in amendment positive column. Similarly, negative columns also, it is optional. So the subtotal from H to K is auto-populated. We'll get the turnover on which tax is not paid, which is also an auto-population. And the total turnover will be auto-populated. So this includes both the turnovers, that is taxable as well as exempted. However, we need to take out the RCM turnover, which is under reverse charge mechanism, for the purpose of comparing with your financial statement. Now coming to the table 6, here we capture the informations with regard to ITC availed during the financial year. So whatever has been captured in the GSTR 3B, it is auto-populated. You cannot amend or make any changes in these fields. This needs to be compared with ITC other than import RCM. Here it is optional. Either you can show input services and capital goods distinctively, or you can show input services under input itself, but capital goods and inputs are mandatory fields. Only input services is optional. Similarly, with regard to unregistered person on which tax has to be paid and ITC is availed, this is currently it is applicable only to the works contractor where they are promoters and where their purchases is less than 80% from the registered dealer. Those transactions will be captured here. And once again, it has to be bifurcated between input capital goods and input services. Similarly, RCM from registered persons on which tax paid and ITC availed has to be disclosed in field D. RCM on import of goods and supplies from SEZ will be disclosed here. So references has been given with regard to table, from GSTR 3B. Now coming to RCM on import of services, this excludes SEZ supplies. This needs to be taken into consideration. And ITC received from ISD. In case of input service distributor, they normally distribute the ITC to their entities of the same PAN. So that ITC has to be captured here. And ITC reclaimed. There are scenarios where ITC can be reclaimed. For example, in case if ITC has been reversed, where payment to vendor is beyond 180 days, based on the payment of taxable value along with tax, ITC can be reclaimed and it can be disclosed under column H. The subtotal B to H will be an auto-population. The difference, that is I minus A, ideally it should be 0. But in case if it is not 0, you have to evaluate and give appropriate adjustment. In case if there is a excess ITC availment, then in that case, it has to be reversed. Column K tran 1, currently this particular column is not very relevant because many of them would have filed their tran 1 returns. So there will not be any items. Similarly for Tran 2 also. Now any other ITC availed not specified has to be disclosed here. What are those? ITC 01 and ITC 02. That is where you have got a registration within 30 days. Any ITC which has been, the vendor has charged prior to the registration can be claimed by this ITC 01. And similarly, ITC 02, whatever the ITC is there, that has to be claimed in this column. So column N, which is a subtotal, K to M, which is an auto-populated. So the total summation of this table, the result will be total ITC, what we have availed by way of GSTR 3B. Now coming to table number 7, details of ITC reversed and ineligible ITC for the financial year. Now this table will list out the ITC which has to be reversed. One is section 37. Here we have to reverse the ITC in case if the payment to the supplier is not made within 180 days from the date of invoice. Question may be asked, for example, if there is a credit period, say for example 270 days, whether we have to still reverse the ITC? The answer is yes, because it is not based on the payment terms, but they have specifically mentioned that 180 days. Of course, this can be litigated at a higher form in order to get any relief, but certainly the matter has to be taken up to either High Court or a Supreme Court to get any relief. Now, section 39 speaks about the credit note issued by the ISD. In case if the input service distributor has, transferred higher value, and if that needs to be reversed by way of a credit note, that amount will be disclosed under section 39 under clause B. Now, under clause C, this is a reversal of common ITC and other than business purposes. So take a scenario that you have got a exempted turnover, or if there are ITC which has been used for the personal purposes. So then in those cases, the ITC has to be reversed under, Rule 42 and 43. 43 is with regard to capital goods, whereas 42 is with regard to input and input services. So proportionate ITC with regard to exempted turnover has to be reversed. Section 17.5 block credit, such as in staff welfare, by car hire or works contract, either it may be carried out by self or it can be given on a contract basis, both are not eligible. Similarly, in case if it is a vehicle, if it is less than 13 seating capacity, ITC has to be reversed. Expenditure incurred with regard to insurance, repairs, all those things are not eligible with regard to motor vehicle. So those has to be reversed under section 17.5. Reversal with regard to Tran 1 credit, both F and G are not relevant as far as the current year will be there. Now, other reversal has to be specified under column H. Now, ITC reversal through ITC 03. So this has to be reversed here in case of compositions. So that has to be disclosed here. And also it is a optional. So you can disclose entire reversal under the respective things, or it can be shown separately. So it is an optional field. So total ITC reversed is an auto-populated things. And the last column, that is column J, will reflect the net ITC available for utilizations. So this is very important field for us, because we need to take into consideration what is the ITC available, or means utilized for the current financial year. Now there is a table number 8, which captures informations with regard to other ITC related informations. That is ITC, here we are comparing with 2A. Now, as you have seen that many notices has been issued where they compare the 2A figures with ITC what has been availed. And then for this financial year 17, 18, 18, 19, there is a provisions in case if we are able to get the declarations from the vendor, we are eligible to claim the ITC. But for subsequent period, there is no such provisions. So now we have to invariably take a position that we have to match with 2A statement and then carry out GSTR 99C. If, for example, if any of the assessee who does not take into consideration GSTR 2A has a basis for the purpose of filing their GSTR 3B returns, they are surely going to get notices from the department for the mismatches. So therefore, we have to take into consideration this reconciliation is being maintained and we have to be well within the limits. Now ITC as per 6B and 6H above is an auto-populated, and under column C we include ITC with regard to including services received from SEZ other than imports RCM but availed in next financial year up to specified date. So the difference will be the ITC, which is also an auto-populated figure. Now this table gives the informations with regard to ITC which has been lapsed during the year. So column E captures ITC available but we have not availed. For example, it has been accounted in the books of account but has not been claimed in 3B, and we have crossed the specified date within which ITC has to be claimed. So in those cases, those information has to be provided here. Or ITC available but is ineligible. So in those cases, the information has to be distinctly captured under the respective fields. IGST on import of goods including SEZ supplies has to be reported under column G, and column H, that is IGST credit availed on import. Now whatever has been paid, how much we have availed on that has to be given here, and this is an auto-populated field, captures from 6E above. The differences, that is G minus H, is also an auto-populated figure. Now ITC available but not availed on import of goods. And finally, we will get the figure ITC to be lapsed in the current financial year. One important fact that needs to be taken into consideration here is GSTR 9, please don't think that it is a year-end activity at the time of filing GSTR 9. We have to carry out this activity on a month-on-month basis. Plus, we need to have the details year-to-date information, such as whatever the ITC we are claiming. Is it matching with my electronic credit ledger? And this has to be mapped on a month-on-month basis. Further, for the subsequent period where the transaction is reflected, which is pertaining to the previous year but reflected in the subsequent year, also needs to be taken into consideration. So that at the time of filing GSTR 9, we have all the informations readily available for the purpose of filing GSTR 9, so that no error, omissions are there in our returns. Otherwise, it will invite higher penalty, that is section 74. This table captures the informations with regard to taxes paid during the financial year. So whatever the tax payable is there. However, I have captured few of the example in the coming slides where we will see in case what will happen if the transaction for the particular financial year has not been captured in GSTR 1 3B, and also in the subsequent period, that is from 1st of April till 30th of November 2023, where it has to be disclosed. Now, whatever the taxes has to be paid, it will be auto-populated here and paid through ITC. All these information is being captured in this field. This table is very important. As you know that GST is unique in its own way, unlike VAT, where we had an opportunity to revise the return. Even under service tax, we had an opportunity to revise the service tax return, that is ST3. But however, in GST returns, we don't have that option. It is only by way of an amendment or correction in the subsequent period. So therefore, it may so happen that the transaction pertaining to the previous year are disclosed in the subsequent period. Previously, it was up to the September, the option was being given to capture the information. Subsequently, they have extended up to 30th of November. So all the transaction pertaining to supplies where the taxes is disclosed or declared in the subsequent period, including the debit notes, has to be captured in table number 10. Table number 11 is with regard to reduction in the turnover or disclosure of credit notes pertaining to the previous year, has to be disclosed under table number 11. Reversal of ITC availed during the previous financial year. So this table is optional. You can give here the informations or it need not be reported here. Similarly, ITC availed for the previous financial year is also optional. But I would recommend that please do not use this optional field because GSTR 9 will have its own relevance as far as assessments are concerned. The reason being is that the authorities rely on GSTR 9 for the purpose of GST audit. So in case if any optional field is been opted and information is not captured in GSTR 9, it becomes an Herculean task for you to prove to the authorities the informations with regard to reversal, because then you have to have the workings in hand to prove that this information is being properly captured. If it is been distinctively disclosed under table 12 and 13, it becomes easier for you to explain to the authorities. Table 14, we are disclosing the differential tax paid on account of declaration in table 10 and 11. So it is a liability which is being discharged in the subsequent period. That is subsequent period from April 23 onwards up to 30th of November 23. In case of exports or SCZ supply or inverted duty structure, the assessees opt for refunds. So in case if they file the refund applications, they have to take into consideration the refund applications filed for the financial year. Now, when we are doing the GSTR annual return for the financial year 22-23, we need to take into consideration the refund application filed for the financial year 22-23, and the information in this table should be disclosed based on the applications filed. Now, the total refund claim, all the fields from A to G are optional. However, based on the refund applications filed, these fields can be filled. When a refund application is filed before the authorities will verify the applications and sanction. The refund amount may be sanctioned for the full amount, or it may be sanctioned for a partial amount, wherein if they find based on the 2A statement or input credit statement provided by the assessee, any ineligible ITC has been claimed, they will reject the ITC pertaining to ineligible ITC or blocked credit and sanction for the refund remaining balance. So here we have to mention the amount of refund sanctioned as per the order. And there will be a refund rejection, as I told, with regard to ineligible ITC or block credit. Those information has to be keyed in column number C. Many a times it may so happen that you file the application and application is still pending because the department has got a time limit within 15 days to acknowledge the applications and within 60 days to process the refund applications. In case if the refund application is pending, that information can be keyed in this column number D. There are scenarios where show cause notices is being issued to the assessee, and based on the reply received from the assessee, the department would have confirmed the demand by way of an order. So in case if any order is being received, you have to provide those information under column E. Out of the demand raised, there may be a situation that in case if you are filing an appeal, there would be a pre-deposit, or you may agree for the demand certain paras and discharge the tax liability against the order for certain paragraph. In those cases, those has to be disclosed in column number F, that is total taxes paid under E above. Column number G reflects the demand which is pending out of total demand raised by the department. It is essential for you to kindly go through the notices issued. Sometimes the department may also issue notices to the email, but it is not there in the portal. Please don't be very casual in case if notices are not there in the portal, that there is no notices issued for a particular client. Kindly check with the management, are any notices received physically or through email, and what actions has been taken against those notices. Call for the reply letters, and finally ask for the status of those notices, whether the department has issued any further communications asking for any informations, whether there is a time limit which has elapsed. In case if the time limit is being provided, say 30 days, and if no reply is being submitted, there are possibilities that the department may confirm the demand. So please ensure that you reach out to the assessee's management and check out for these information, though it is optional. But the thing here is correct position with regard to the liability cannot be provided if you do not obtain the informations relating to these details. Now, table number 16, it is only for the disclosure purposes. Here, informations on supply received from composition taxpayers deemed supply under section 143 and goods sent on approval basis. So the GST department wants to capture the information with regard to supplies received from composition taxpayer. They have got a analytics for which these information is being captured, so that they try to see how much is the composition taxpayer turnover is there. With regard to the deemed supply, that is under section 143, this scenario will raises when the principal sends out the input and capital goods to the job worker. With regard to input, the time period given under the GST provision is that within 1 year it has to be received back. And with regard to the capital goods, the time period allowed is 3 years, excluding jigs fixtures. For that, there is no time limit. So in case if any goods have been sent out to the job worker, and if it is not being received within a period of 1 year with regard to inputs and capital goods within 3 years, then that information has to be captured in this column. Similarly, there are scenarios where the goods will be sent on approval basis. Here what happens? For example, the daily products, for example, batters, these things will be, sent on an approval basis to the kirana shops or the malls. And in case if they don't receive the goods within 180 days, then in that case, that will be treated as a supply from the date of invoice or from the date of dispatch of goods, and they have to pay interest along with the tax. So those information is captured in GSTR 193B. Here it is only the disclosure aspect. This is very crucial things as far as outward supplies are concerned. HSN detail or SSC detail has to be provided. Many a times it may so happen that though the assessee's turnover is more than 5 crores, but yet they are not capturing these informations in their GSTR 1 return. When it comes to the supply of goods, they need to have a unique quantity code, total quantity, and rest other information has to be captured. It may so happen that when it comes to the goods, many of them, they don't have the quantity details. Wherever it is possible, kindly insist for a trading account along with the quantities. This is going to help at the time of GST audit. Similarly, HSN-wise summary for inward supply. However, it is optional. But in case if the information is available, kindly ensure that these are all informations to be captured in GSTR 9. This will help you at a later point in time. This chart gives the digit of HSN which has to be captured in GSTR 1 and GSTR 9, where the registered person's aggregate turnover in the previous year is up to 5 crores. The total digit to be captured is 4 with regard to B2B supply. As far as B2C supply is concerned, it is optional. Where the registered person's aggregate turnover in the previous financial year is more than 5 crores, they have to capture 6 digit. And here it is mandatory for both B2B supply as well as B2C supply. However, for certain chemicals and import and export of goods, it is mandatory to capture 8-digit things. The reason being is that the customs there, the informations with regard to HSN to be captured is 8-digit. So therefore, under GSTR 1 and 3B also, they need to capture 8-digit. We come to the last table, that is with regard to late fee payable. This will come into picture only in cases where GSTR 9 return is not filed within the due date. Now, in case if we fail to file the GSTR 9 within 31st of December 2023, then late filing fee is applicable. And in case when you are filing the GSTR 9, kindly compute the late filing fee and file the GSTR 9 along with the late filing fee so that you can avoid future notices. I believe now it is computed by the system itself so that you don't have an option. Previously, in the previous year, there was this late filing fee was not been populated. So therefore, many of the assessees were not filing not paying the late fees in case of delay in filing GSTR 9. Now, this table will give you a snapshot. What is the relevance of each table? In order to arrive at the total turnover, we need to take into consideration table number 4, that is turnover with payment of tax. This also includes ITC turnover. We have to be very careful. But however, when you take into consideration the summary of table 4 and 5, that is total, the RCM turnover will be eliminated. So table 4 plus table 5 and plus table 10 minus table 11 will give us the total turnover and the total tax liability. Now, how do we arrive at the total tax liability? As you are aware that table 5 captures only where there is no tax, or either it is zero rated supply of exports, LUT with SEZ turnover, or exempted. So therefore, that is not taken into consideration. Table 4 plus table 10 minus table 11 will give us the total tax liability. Now, with regard to input tax credit, we have to refer to table 6 minus table 7. How do you arrive at total tax payment? That is with regard to table number 9, where the taxes has been paid in GSTR 3B for the financial year. And table number 14, the taxes paid in the subsequent financial year, that is from 1st of April 2023 up to 31st of December 2023. And also we need to take into consideration DRC 03 in case if the turnover is missed out to be disclosed in the current financial year or subsequent financial year. That we will take into consideration with the help of an examples. Now the question arises, in case if the transaction is not been reflected in a particular financial year, under which table this needs to be disclosed. Now taxes paid in 3B up to March 2023. So invariably you have to disclose those information in table number 4. In case if the tax is being paid in 3B till November 23, so information has to be reported in table number 10 and 11. So any balance tax payable is there, it has to be paid through DRC 03. Now, in order to summarize what we have discussed, this is the summary. If one, goes through these things, they will never miss out any, informations in capturing in GSTR 9. So outward supply made during the financial year, you have to capture this information in table number 4, and table number 5 is with regard to tax payments. Now, outward supply for the financial year 22-23, but reported and tax paid in subsequent financial year, we have to refer these informations in table number 10 and table number 14. So either it may be an adjustment in outward supply with regard to financial year 22-23, but made adjustment and reported in subsequent financial year, the same table number 10 and table number 14 has to be referred to. In case if any adjustments with regard to negative things, then in that case, it has to be referred to table number 10 and 14 once again. So both these informations will be captured in the subsequent period. Now coming to debit note, credit note pertaining to the outward supply of the financial year 22-23, but made or reported in subsequent period, table 10 or 11 as the case may be. And table number 14 is with regard to tax payment for the subsequent period has to be captured. Now outward supply pertaining to the current financial year and reported and taxes paid in the same financial year 22-23, then in that case we have to refer to table number 4 and table number 9. This information has to be captured there. Now any advances received in current financial year but invoices is not yet raised or issued, then in that case this has to be disclosed. There is a typo error, it should be 22-23. So this has to be reflected in table number 4 and table number 9. So table number 9 refers to the tax payment. And lastly, outward supplies of financial year 22-23 but not reported. As I told that in case if the turnover is not captured in GSTR 3B, then in that case, even though it is not been captured, it can be declared as an additional turnover in table number 4, and taxes has to be discharged through DRC 03. Now, with regard to inward supplies, that is ITC. So, in case if it is during the financial year 22-23, table 6A, if it is reported in the subsequent financial year, then in that case, table 8C and table 13. If any additional things has been availed and reversed, then in that case, once again, table 8C and table 12. ITC pertaining to previous year availed during the financial year 22-23, table 6B and or table 6M, here reversal has to be done. Then ITC to be reversed for the financial year 22-23, but not reported in form 3B even after 30th of November 2023 or not reversed at. Then table 7H and table 9. And ITC to be availed of financial year 22-23 but not reported in GSTR 3B even after 30th of November or not reversed at. So table 6B, this will be a lapsed ITC. Now we will see with example with regard to excess turnover reported. Obviously, we come across the scenario where we would have reported in 3B higher turnover when compared to GSTR 1 as well as books of account. So in this example, the turnover as per books of account is 1000. However, in GSTR 1, we have reported 900. In 3B, we have reported 1100. So when we compare, we come to know that there is an excess turnover declared in 3B and taxes also have been discharged accordingly. Now, the excess turnover has been reversed in 3B of subsequent financial year. So then in this scenario, how the reporting in GSTR 9 has to be done. In table number 4, we predominantly take into consideration the turnover declared in GSTR 3B as a basis for reporting in table 4. So you report the same turnover what is there in GSTR 3B for the financial year 22-23, that is 1100. And in table number 11, where it has been reversed in the subsequent financial period up to the specified period, this turnover has to be reduced. So the total turnover what we will get is the turnover as per the books of account. So there is no differences in the books of account versus the GSTR 3B versus GSTR 9. Now we will see the transactions where there is a short reporting in the current financial year. The turnover as per books of account is 1000. The turnover disclosed in GSTR 1 is also 1000. So there is no difference. However, in GSTR 3B for the current financial year, the turnover disclosed is only 600. In the subsequent period, they have only disclosed to the extent of 100 rupees. Still, there is a gap of 300 rupees. However, the moment when they came to know that there is a difference, they have paid taxes on 250 by way of DRC 03. So, if you take into consideration, there are 3 turnovers as far as GSTR 3B is concerned. That is one 600 rupees, which is being disclosed. The second one is disclosed in the subsequent period, which will find a place in table number 10. The taxes which has been disclosed in DRC 03, that turnover has to be disclosed in table number 4. And the turnover which has been left out, that is not reported, also should be reported in table number 4 itself. Now, if you take into consideration the total of table number 4, it will be 900 plus table number 10, 100. The total turnover will be 1000, which will match with books of account as well as GSTR 3B. This is how we have to take into consideration the reconciliation. Now we will come to ITC part. What happens in case if there is a excess ITC claimed in the current year? Now, ITC as per books of account is 1000. In 3B, we have claimed 1100. Now, when we are doing the monthly compliances for the subsequent period and reconciliation, we came to know that the excess ITC has been availed in the financial year 22-23. The same has been reversed in GSTR 3B. Now, under these circumstances, we have to disclose in table number 6, 1100, and in table number 12, reversal, we have to show it 100. We'll get a total ITC of 1000, which will match with our books of accounts. This is a scenario where we have short claimed ITC in the current financial year. ITC as per books of account is 1000. As per GSTR 3 for the financial year, it is only 800. In the subsequent period, we have claimed excess because after the close of the financial year, when we did a reconciliation, we came to know that there is a short claim of ITC in the GST return. So therefore, we have claimed 200 rupees in the subsequent period. So how it has to be disclosed? In table number 6, 800 will be disclosed. In table number 13, whatever we have claimed additionally in the subsequent period, it will be disclosed. The total ITC will be 1000, which will match with our books of account. Now we'll come to the situations when we have to file nil GSTR 9. Is it only that we need to take into consideration only outward supply or only the inward supply? If there are no inward supply, can we say that, okay, we can file nil return? There is no liability. There should not also be any liability of any kind. Further, we should not claim any credit during the financial year, nor we should have received any order creating any demand. So that is the reason when I was referring to the orders and demand, though it is an optional things. In case if you file a nil return, then the department may come and say that though there is a demand order, but you have not reported in GSTR 9, so you have concealed the information. It is always better kindly exercise this option very carefully, where the information is not proper or where you do not have the information available or cannot be collated because the assessee is not keeping the information in such a way that where you can collate the information as required by GSTR 9 tables. Only in those cases, and that too, after informing the client that in case if they are using the options, what are the risks that they are running. Suppose that you can exercise this option. Otherwise, I would suggest that you kindly fill all the fields what has been given in table in GSTR 9 tables. Further, we should not even have claimed any refund. So, in conclusions, there should not be any outward supply. There should not be any inward supply. No liability. We should not claim any ITC, nor we should receive any notices or means not any order creating a demand, nor we have filed a refund application. Only under these circumstances, we will be able to file nil returns. Also ensure that wherever there are different distinct entities, though there might not be any turnover, please file nil return. Otherwise, it will invite late filing fee. Now we'll come to the process. What is the process adopted for filing GSTR 9? So you need to log into the system, navigate to GSTR 9 annual return. Then you have to, here it is very important before you start the process of GSTR 9, that you have the information GSTR 1 3B summary, GSTR 9 summary, and table 8A document details. And please compare that with the GSTR what you are filing. If there are any differences in the figures, please kindly verify on what account the differences are there and give adjustment accordingly. Otherwise, this will invite notices. Enter the details in various styles. For that, kindly refer to GSTR 9 and find that is summary, GSTR 9 summary. And wherever there are differences, kindly have a reconciliation for those tiles. Keep it in handy, because in case of any notices, you can produce to the authorities and save the client, from unwarranted demands. Preview the draft form GSTR 9 summary, compute liability, and in case if there are any delay in filing the GSTR 9, pay the late fee if any, and preview draft form GSTR 9 and file GSTR 9 with DSC or EBC as the case may be. Now we'll take into consideration few of the FAQs. Now, is form GSTR 9 required to be filed at entity level or GSTN level? As I told you, as far as income tax is concerned, though the entity may be having a single PAN and they are required to file one income tax return at the entity level, as far as GSTN is concerned, the entity may have the different GSTN within the same state, or it may have a different GSTN where they have got a registrations with other state. So we normally call it as a distinct entity. So as far as GSTR 9 is concerned, this has to be filed at the GSTN level and not entity level. So each GSTN registration has to be filed GSTR 9 return. If you have got 10 GST registration, for all the 10 GSTN registrations, you have to file GST 9 returns. Even if it is a nil return, it has to be filed. Otherwise, it is treated as a non-compliances and late filing fee will be levied for delay in filing the returns. Now, can registered person edit auto-populated data from form GSTR 1 and 3B in form GSTR 9? Yes, you can edit auto-populated data from the filed GSTR 1 and 3B figures in GSTR 9, except ITC as per 3B or ITC as per 2A and details of taxes paid. The one which has been highlighted in red colors cannot be edited. These are all auto-populated and you cannot make any changes in this. So that is the reason you have to have a system before the end of the financial year, that is from Feb and March. You have to have a very close look. Kindly refer to GSTR now 2B. You have to invariably take into consideration for filing GSTR 3B. And at the same time, whether all the ITC has been accounted. There might be a situation that the vendor might have filed their returns, but however, the goods have not been received. Hence, you will not be able to claim the ITC in the books of accounts and also in GSTR 3B. So a reconciliation has to be maintained and claim ITC once the goods are received. We have to follow the provisions of law. It cannot be claimed just because it is appearing in 2B. Now, can additional liability not reported earlier in form GSTR 3B be declared in form GSTR 9? The answer is yes. Additional liability not reported earlier at the time of filing GSTR 3B can be declared in GSTR 9 and it has to be discharged through GST, means through DRC 03. Ensure you have to take into consideration
the DRC filed for a particular financial year and have a reconciliation before you finalize GSTR 9. So collate the informations of DRC 03 filed. Either it may be on account of notices or it may be on account of any other reasons. Kindly take into consideration the remarks what has been given in that, and appropriate adjustment needs to be given in GSTR 9 returns. Now, can we claim or report any unclaimed ITC through annual return? The answer is big no. GSTR annual return, as far as ITC is concerned, it is only a disclosure things. It will not have any impact on your electronic credit ledger. It is only a disclosure. So therefore, you cannot claim any unclaimed ITC through DRC 09. So in case if you fail to claim the ITC in your GSTR 3B of the current financial year or up to the specified period of the subsequent financial year, the ITC will be lapsed. Many a times it may so happen that GST on RCM, particularly import of services, is being paid, but they fail to claim it in the GSTR 3B return. And they also fail to claim the same thing up to the specified period in the subsequent financial year, because of which, there will be a lapse. There is no mechanism to claim that one. So kindly ensure that there is a reconciliation statement prepared for all the RCM, what has been paid, and whether the same has been claimed in the GSTR 3B of the current financial year as well as subsequent financial year for which GSTR 9 is filed. Can we revise Form GSTR 9 after filing? The answer is big no. We cannot revise GSTR 9 return after filing. There are scenarios where, even GSTR 9, though it is a last opportunity to rectify the mistake, even that also are being filed wrongly. Now, what is the option available before the assessee in those cases? The moment when such situations is identified, normally what happens, it will go unnoticed. But the moment when somebody identifies that there is an error in GSTR 9, in those cases, identify the mistake, write to the authorities, the mistake and the treatment of the mistake with regard to payment of tax, reversal of ITC, whatever it is, and kindly write to the authorities and keep them informed along with the documentary evidences so that you can avoid penalty at a later point in time. There is a unique features as far as GST is concerned, that is DRC 03, where we declare the informations voluntarily. So in case if anything of that sort is there, kindly use this route DRC 03, give the appropriate remarks in DRC 03, which should be self-explanatory, so that the authorities, when they refer to DRC 03, they come to know the error, omission, mistakes, which is been rectified by way of DRC 03, and they give the benefits to the assessee. Another important thing that we need to take into consideration is that GSTR 9 does not allow us to key in any of the comments, observations. We don't have that option. We have that option only in GSTR 9C, self-certification. So therefore, wherever the turnover is less than 5 crores and where there is no option to file GSTR 9C, in those cases, kindly ensure that GSTR 9 is self-explanatory. All the fields are being reported, even though they are optional. Please do not exercise the option. And then, in case where DRC 03 is being filed, please give appropriate remarks, which should be self-explanatory. so that authorities can understand the reason for filing GSTR 03. Now, what is the primary source of data for declaration in GSTR 9? As per the press release dated 4th June 2019, DRs means GSTR 9 is driven by GSTR 3B for the simple reason that in GSTR 3B we pay the taxes. Hence, whatever has been disclosed in GSTR 3B, that will become a basis for us to report in GSTR 9. However, there are certain fields where GSTR 1 also is being referred to. In many cases we have seen, but predominantly GSTR 3B will drive our GSTR 9. We have come across many occasions wherein the RCM for a particular financial year has not been declared in the GSTR of that particular year, but declared in the subsequent financial year. Now the question arises, in which part of GSTR 9 the informations with regard to RCM which has been missed out has to be declared, whether it is in the previous year pertaining to which RCM liability was there, or in the year in which RCM liability has been discharged. As per the press release, it has been informed that RCM of the current year, in case if it is declared in the subsequent period, it will form part of GSTR of the next year, and it need not be disclosed in the current financial year to which it is pertaining. So it is based on the payment. In case if it is paid in the subsequent period, the RCM GSTR 9 has to be disclosed in the subsequent period and not in the current period. Now, output tax not declared in GSTR 1, and also it is not declared in GSTR 3B, but has been remitted through DRC 03, where it must be declared in GSTR 9. So as I said, whatever the turnover which has been missed out in the current financial year and also in the subsequent financial year, in those cases, it has to be disclosed in table number 4 of GSTR 9. This will result in a difference between tax payable and tax paid in table number 9. Now, table number 9 predominantly takes into consideration the liability what has been discharged in GSTR 3B for the current financial year. These differences, the liability, whatever is shown, it has to be matched with DRC 03. So whatever the difference is there between these two, for that you should have a DRC 03 so that you can have a reconciliation. So even though in case if you have missed to report it in GSTR 1 3B, and if you are able to identify such missed out transaction at the time of filing your GSTR 9, even post 30th of November, please include it in GSTR table 4 and discharge the liability through DRC 03. Please don't ignore this turnover. Ensure that it has been properly captured. Now, with regard to GST portal, it is not auto calculating late filing fee. This we came across in the previous period, but I think in the current financial year it is auto populated. So accordingly, without paying fees, you cannot proceed further. So therefore, only thing what we wanted to highlight here is, in case if there is any late filing fee, kindly ensure it is appropriately paid before filing the GSTR 9 so as to avoid the notices. Now I would like to conclude with certain points, which everyone has to take into consideration before, carrying out the filing activity of GSTR 9. Point number 1, GSTR 9 is a final opportunity for the assessee to rectify the returns wherein the errors are there. Either it may be pertaining to the current financial year or the financial year subsequent to the current year up to 30th of November 2023. This is point number one. Point number two, you don't have an option to rectify the errors which is there in GSTR 9. So therefore ensure that it is being verified. There is a maker and checker concept so that the one who has prepared it can be checked by another team member so that any errors can be identified and rectified before filing the GSTR 9. The third thing, it will act as a reconciliation statement between the books of account and the GST return. So ensure proper reconciliation is being carried out before you file the GSTR 9. Fourth, it will be a basis for the departmental authorities when they take up the GST audit, departmental audit. So in case if the assessee makes a proper disclosure, that will safeguard them so that there will not be any unforeseen penalty or notices either under section 73 or under section 74, which also invokes penalty at the rate of 10% or 15% or 25% or 50%. It all depends upon the stage at which you accept the liability and discharge along with the penalty. So therefore, it will be an added burden to the assessees. We, as a professionals, we have to help the assessees so that they can overcome these unforeseen events. And finally, you have to have all the documentary evidences. I would like to touch upon certain important aspects. Many times we ignore agreement copies with regard to transactions such as exports, because these are all based on the agreements, that is master service agreements will be there. We have to take into consideration the invoices. Kindly take into consideration the receipt voucher, payment voucher, refund vouchers, self-invoicing. Self-invoicing is applicable in case if it is an unregistered person on which RCM is applicable. So all these documentary evidences has to be maintained by the assessees. Many a times these documentary evidences are not being either prepared by the assessee or the consultant. Ensure that you have all these information. To conclude, GST is document-based audit. So for each and every transaction, it should be supported by the document. Ensure that proper documentary evidences are being maintained and it is a part of your workings, so that in case if there are any notices, you will be able to substantiate it. So with this, I conclude the GSTR 9 for this session. Thank you for patient hearing. In case if you have any queries, I'm happy to take it. Over to you, Sahana. Hello, Sahana. I'm unable to hear your voice. Hello, Sumitra. I am unable to hear your voice.
And the way you introduced the concept and the complex thing was really made it an interesting session. So thank you so much, sir. Yes, sir.
You will never get a job in Europe, Canada, or Australia until you start dominating your LinkedIn profile and stop making the silly mistakes while applying for a job abroad. Are you a working professional stuck in India and looking for a job in Germany, Netherlands, France, UK, Poland, Canada, or Australia? In your home country, then this video is for you. Hi, I am Sandeep Khera, a software engineer. I moved to Germany in 2014 and got a job here. Now,
Particular period.
There was one day when I lost all my money. I was initially doing a lot of F&O.
We are looking today. Predominantly in GSTR 9, we tried to reconcile the turnover basically from the outward, inward, and the transactions which are pertaining to the current year, but however disclosed in the GSTR return 3B and 1 in the subsequent period up to the specified period. When I mention the specified period, it is up to 30th of November of subsequent period. Now the outward supply is bifurcated into two categories. One, the disclosure of transaction on which tax is payable. It has got various category of transaction such as B2C, B2B, exports, SEZ supply, deemed supply, advances. Also, it has got the transactions such as deemed supply. So we need to take into consideration why this categorization in the first instance, when the tax is being paid on the transactions, why this classification is required to be disclosed in GSTR 9. Point number one, each line item has got its own relevance. Now, if you take into consideration B2C transaction, up to 5 crores, there is no requirement to disclose the HSN code. However, for B2B, it is required. So therefore, each line item has got its own relevance. So accordingly, it is been classified in the GSTR 9C as well as GSTR 1. However, in GSTR 3B, we give the information in a consolidated manner, unlike GSTR 1. Now, I further dwell upon a couple of instances, particularly with regard to SEZ supply and exports. Now, there are conditions attached to SEZ supply as well as export supply. In case if it is a supply to SEZ, within 3 months, we need to obtain the endorsed copy of the invoice from the specified officer of the SEZ, stating that the goods or services are being used for specified purposes. Now, what will happen in case if we don't get the endorsed copy? In those cases, even though we are utilizing or making use of LUT against the supply to SEZ, this transaction will be subjected to tax. So it is a conditional zero-rated supply. Just to give a couple of instances, there is a allied educational institution which was providing services to SEZ unit since from 2017-18. However, the educational institutions were not obtaining the endorsed copy of the invoices from the SEZ recipient. The books of accounts were subjected to audit under Section 65. Notices have been issued, and when we submitted the information, the departmental authorities found that there is a SEZ supply, and they called for endorsed copy of the invoices. Assessee stated that these being the initial stages and there is no specific requirement to obtain the endorsement, they did not provide the endorsement, and ultimately an order has been passed demanding tax on the SEZ transaction. See, why I am referring these kind of instances at this stage, at the beginning of the reconciliation statement here, is that we need to understand the implication of each and every line item, what is being stated in GSTR 9, because it will have a bearing on the tax liability. Now coming to exports, as you are witness that during COVID times, many of the entities who were doing foreign supply, either it may be goods or services, they were not able to collect the amount on account of supply. So there was an outstanding. These outstandings were beyond 1 year. Now, under these circumstances, in case if the amount is not received within 1 year from the date of the invoice, then within 15 days, the assessee has to seek a permission from the commissioner of the jurisdictional authority, seeking extension of time. In case if they don't do it, what would be the repercussions? Point number one, the LUT will not be valid for all the supply which they undertake without permissions. For that, there is an exposure of output liability at the rate of 18%, which will be a very huge as far as exports are concerned or entity is concerned. It will hit their bottom line. Sometimes the TP profit margin is to the tune of 15%, but whereas our GST liability is 18%, so therefore there are chances that the entity will incur the loss. Now, coming to the other aspects, that is with regard to transactions where there is no tax liability. They wanted to capture these informations, though it has got no relevance from the reconciliation point of view. But however, I would like to stress upon certain things. When we look upon GSTR exempted turnover or nil turnover or a non-GST supply, these categorization has to be proved beyond doubt. When there is an exempted supply, we have to ensure that the condition attached to those exemptions has to be fulfilled. Just to give one example, in case of an training institution, they were exempted under 12/2017. But however, the conditions for exemptions have not been fulfilled. But however, the entities were claiming exemptions on a year-on-year basis. When the entity was subjected to GST audit, and when documentary evidences were called upon, they were unable to provide the documentary evidence. So at that point in time, the department has confirmed the liability. And these liabilities were confirmed for 3 consecutive years. So there is an exposure of tax, interest, as well as penalty. Sometimes this will be to the tune of 50 to 60% of the total turnover. So kindly ensure that when we are making a disclosure under the category where the turnover is not subjected to any tax, we have to be very careful. And all the conditions attached to those things are being fulfilled. Documentary evidences such as endorsed copy of the invoices in case of SEZ supply, or EBRCs in case of foreign exports have to be there on record. Otherwise, there would be an exposure. Now, coming to the third aspect, that is, based on this, we would have declared the taxes in the GSTR 3B. The first one was the supply on which tax is payable. The second table discloses the turnover on which there is no tax liability. However, the RCM has to be removed, which is not a part of the turnover. it is separately paid and ITC will be claimed according to that. Further, as you are aware that under GST, there is no mechanism to file the revised return. The only option available is to correct or to make the amendment in the subsequent period in which the errors or omissions have been found out. So under those circumstances, obviously, the transactions would be reported at a subsequent period or after the end of the financial year. So in those cases, those turnovers has to be, has been disclosed in the subsequent period, which also calls for a reconciliation. So there is a separate columns, both for outward as well as inward supplies, which will be disclosed in GSTR 9. So these are all spillover transactions. So an entity need to have a reconciliations kept, otherwise it will be a problem at a later point in time. The last category is with regard to the other informations, wherein we provide the informations with regard to refund, demands raised, so on and so forth. Another important aspect is with regard to HSNY summary. Outward, it is compulsory. As far as inward is concerned, it is optional. So with this, we will be able to file GSTR 9. Now, before we dwell upon GSTR 9C, I would like to stress upon certain basic things. Point number one, we need to have the working in one working file. Many a times it may so happen that the informations are scattered. Now this will become or pose difficulty in preparing GSTR 9C, and also sometimes at the time of representation before the departmental authorities, we find challenges because the informations are not handy. Kindly ensure that there is only one working file with regard to GSTR 9C. That is point number one. Point number two, there are many reconciliation statements which has to be kept before we take up GSTR 9C. Point number one, outward reconciliation between GSTR 1, 3B versus books. Point number two, ITC as per books, 3B as well as 2A. This has to be kept. The third important aspect is with regard to RCM. So it should be basis the imports, the taxes paid on imports, both as goods as well as services, as well as domestic RCM liability. This has to be matched with ITC, what has been claimed on a monthly basis. Further, we have to take into consideration the timing when this RCM has been disclosed. Now, whether the RCM is pertaining to the previous period disclosed in the subsequent period, then kindly ensure that that RCM should not form part of GSTR 9 of the previous year. It should be disclosed in the year in which RCM has been paid. So these are the basic aspects which we have to take into consideration before we start with GSTR 9C. Now we have seen what needs to be kept in mind as far as GSTR 9 is concerned. Now we move on with GSTR 9C. Point number one, where the aggregate turnover of an entity exceeds more than 5 crore, this is PAN level. Take an example that an entity has got 5 registration at 5 different states. The turnover of all the 5 states put together based on the PAN is more than 5 crore. Then in that case, the GSTR 9C is applicable. Now take a scenario that out of 5 states, only one state has got a turnover and all the 4 states has got no turnover. They are filing nil returns. Even though they file nil returns, they have to file GSTR 9C compulsorily. So it is on an entity level turnover has to be considered. And once it crosses more than 5 crores, GSTR 9C has to be filed. Now the question arises, what needs to be filed along with GSTR 9C? So we need to file the annual return, the copy of audited annual accounts, and a reconciliation statement in 9C has to be filed. The due date for filing 9C is 31st of December. We are left with almost only 1 month, and there is no possibility of extension. We have been used to extension of GSTR 99C in the earlier period, but mind you that from the previous year, there is no extension. We don't see any extension this year as well. It is always better to file both GSTR 9 and 9C together. The reason being is that when you are comparing 9 with 9C, there are chances that any liability which has been missed out can be taken into consideration in 9 itself, and then the payment can be made in DRC 03. Otherwise, there will be a reconciliation between 9 and 9C. To the extent possible, avoid the reconciliation between 9 and 9C where there is a difference in turnover or ITC. Kindly adjust everything in 9 and ensure that the differences are 0 to the extent possible, so that you will not receive any kind of notices from the department. Just to give you an example, in one of the cases, an assessee has declared an extra 0 in the GSTR 9C, because of which there is a huge turnover gap. And immediately the department has issued a notices, and then we have to reconcile with GSTR 9, provide the explanation that there was an inadvertent error in capturing an additional 0, and it has to be substantiated to the authorities, and based on that, they drop the notice. Further, based on this observation, CAG auditor also has issued a notices for the same period with the same observations. So we have to once again give the explanation. So sometimes it will create a nuisance in case if there are any differences, either arithmetical or whatsoever. So kindly ensure that it is being verified. There should be a maker and checker checks so that all these errors are ironed out before filing the GSTR 9C. The most important aspect that we need to take into consideration is invoice level reconciliations. Either it may be outward or it may be inward or RCM. We need to have invoice level reconciliations, then only we will be able to identify the differences. If you are doing it on an overall basis, you will not be able to identify where the error is. So kindly ensure the working paper should have the invoice level reconciliation. As I mentioned earlier, kindly file the nil return in case if there are multiple registrations and if any of the registration is not having any turnover. Then in that case, please do not ignore. You file the nil returns in order to avoid the late filing fee. Kindly ensure that there is a verification mechanism so that there is no error which is crept in GSTR 9C or 9, and these returns cannot be revised. So what are the changes in GSTR 9C? There are only a couple of changes. One is there is a new rate which is being prescribed, which is applicable only in case of brick manufacturing. And another thing is with regard to table number 14. So this is the table which captures expense-wise details, ITC claimed based on expense-wise. So this has been continued as an optional field. However, it is always better. The reason being that when a particular entity is called for an audit, the officer would like to see what are the expenses on which ITC has been claimed. The reason why they want to see the categorization of ITC based on the expenses is that they want to understand, are there any blocked credit? For example, staff welfare expenditure or car hire for an employee. Either it may be a works contract services which has been taken for the purpose of construction of a office or a factory, or it may be the purchase of goods or services with regard to construction of office or a factory, barring certain exception. So under these circumstances, the officer would ask the assessee to prepare the ITC based on the expense wise on which ITC has been claimed, on which ITC has been blocked. Further, when you are preparing the input tax credit register, ensure to capture the HSN or SAC code. This will be handy when you prepare the when you present before the authorities, because they would be asking for invoice copies. Otherwise, it will add on to your extra effort in pulling the informations with regard to invoices. In case if SAC code or HSN code is provided, based on that, the authorities will be able to take whether it is allowable expenditures or block credit or restricted. The most important thing that we need to take into consideration here is that as far as GSTR 9 is concerned, still we are referring to GSTR 2A. However, when we are filing the GSTR 3B return, we are comparing with GSTR 2B. So there are possibilities that there would be a wide difference between these two statements. In those cases, it is always better you may raise a grievances on the GST portal and bring it to the notice of the authorities, so that in future there will not be any unforeseen events. Now, what are the documents required before we start with GSTR 9C? First thing is audited financial statement. This also is required as far as GSTR 9 is concerned. Ensure that registration-wise trial balance is there. And if possible, kindly get the authorization from the management, or if the statutory auditor is certifying, it is really good, because that will be taken at the face value. We need GSTR 9 filed return or the finalized GSTR 9 along with the supporting documents such as GSTR 3B, GSTR 1 returns, as well as the system computed summary report, GSTR 1 and GSTR 3B, as well as 9. Also obtain IT returns so that the turnover details are reconciled with the turnovers as per the GST return. This is an area where most of the people, they don't give importance. But however, when the audit is completed, or when self-certification is completed, there are chances that there are huge differences between IT returns and GST return. This may be because of the accounting policies. I would like to stress upon the areas where such kind of differences would exist. Number one is the turnover as far as financial statement is concerned is based on the matching concept. But however, under the GST, it is based on the time of supply. So there are possibility that in case if we receive the advances, these advances may not be a revenue as far as financial statement is concerned, it is a liability. But however, from the GST perspective, the assessee would have discharged GST liability as soon as he has received the advances. So this is only with regard to services and not with regard to goods. Further, there are chances that the assessee may be into both taxable supply as well as exempted supply, and they may be having a cross-charge mechanism. So what is cross-charge? Take a scenario that an assessee is having two registration in two different states. Under these circumstances, they do not have the accounting team, the HR team, or the IT team. All these things will be managed from the HO. The branch will not have the independent resources as far as this is concerned. So under these circumstances, in case if the branch is able to take the full input tax credit, then in that case, whatever the value attributed by the HO to the branch can be taken as an input by the branch, and there will not be any question on the valuation. But in case if there is a both taxable as well as exempted turnover, then in that case, valuation will kick in. The reason being is that they will not be able to utilize the input tax credit. It will not be a scenario of a revenue neutral. So under these circumstances, the valuation has to be adopted. So in case if it is a related party, if further supply is being done, then in that cases, they need to, value the transactions, and accordingly, it has to be reported for the GST purposes. However, under the income tax or for the purpose of financial statement, this will not be a turnover. So there is always the possibility that there might be a turnover in the GST return, but however, the same is not recognized in the financial statement, or there may be a vice versa. Now moving on to the 26A statement, what is the relevance of 26A statement? Here we need to take into consideration the turnover what has been disclosed in GSTR in the IT return as well as GSTR returns has to be mapped with 26A statement. The department, when they call for an audit, invariably ask for a reconciliation because all these three items will have a differences. So this has to be reconciled. Now, in case if it is reconciled well in advance, it becomes easier to give appropriate disclosures in the respective returns. Now, we need to take into consideration electronic credit ledger, electronic cash ledger, and also the DRC03. So there are situations wherein assessee would have discharged the tax liability through DRC03 when there is a notices and the department specifically asks to discharge the tax liability. The assessee would have taken the route of GSTR 03 and discharge the tax liability. We need to have these informations in hand. Now we move on to GSTR 9C. So basically what we are doing in GSTR 9C is that we are capturing the basic detail, which is similar to GSTR 9. The only additional point that is captured in GSTR 9C is, are you liable to audit under any other act? Here we need to give the provisions under which we are subjected to audit. Then there is a reconciliation of turnover declared in audited financial statement with turnover declared in GSTR 9. So this is very relevant. So for the purpose of GSTR 9C, the turnover as is disclosed in GSTR 9 has to be compared with financial statement. And once we know the supply, then we have to reconcile the taxes paid. And we move on to the reconciliation of ITC credit. If there is any additional liability due to non-reconciliation, that has to be discharged. So basically what we are doing is we are comparing the outward supply. So outward supply has got, as far as 9 is concerned, is a composition of both taxable as well as non-taxable turnover. And we arrive at a taxable turnover as far as 9C is concerned. Reconcile with the taxes paid. We do the reconciliation of ITC. And then if any additional tax liability is there due to non-reconciliation, the taxes will be paid. Now, with regard to the basic information, it is similar to GSTR 9, as I already mentioned. The only additional field which captures is the name of the act if you are liable to audit under any act. So normally you have come across audit under income tax, that is tax audit, or it may be a company audit in case of private limited company. So this fact has to be disclosed in serial number 4.
More than learning coding, it is important to learn it the right way. Get structured learning experience with Coding Ninja's 9-month job bootcamp, designed for working professionals. This full-stack development bootcamp can help you earn 128% salary hike with complete job assistance. Want to know more? Register for a free webinar now.
Now moving on to the table number 5, that is reconciliation of gross turnover. Now turnover including export, this is as per the audited financial statement for the state or union territory. This one need to take into consideration. Now we take the same example, that is an entity is having a 5 registration in 5 different states. And they have got only turnover in the state of Karnataka, which is also a head office. Under these circumstances, the turnover pertaining to only Karnataka state, when we are doing a GSTR 9, has to be taken into consideration. So for these purposes, you need to have a trial balance. And in case if this trial balance is certified by the statutory auditor, it is well and good. Otherwise, we have to get the management authorizations on this trial balance. And the same thing can be uploaded along with 9C. Though it is not a requirement, but it is always better to make it a part of your 9C. Because at least the department cannot take a position that information has been suppressed. Since it is already uploaded in the portal, which is available for review of the departmental authority, we can state that the information is already provided. Taking the turnover as per the audited financial statement as a base, we arrive at the turnover as disclosed in GSTR 9. Now table 5B to 5O invariably have the line items which has differences between GSTR 9 and audited financial statement. Now we will see each line item one by one, and also their treatment, whether it has to be added or deducted based on each transaction. It has to be evaluated. Having done this exercise, in case if 5R column is 0, it is a safe, but however, normal circumstances, always you will find a difference for one or the other reasons. If it matches, then we have to be doubly sure that there are no errors, omissions in our reconciliation statement of gross turnover. Now we will take into consideration each line item one by one. Point number 1, as I said, GSTN wise turnover has to be declared here. For example, if there is 50 crores on an overall basis and only 20 crore is pertaining to Karnataka, then only 20 crore has to be taken into consideration. So for that, how do you come to know about the turnover? For that, you need to have a trial balance of respective GSTN. Now, we also need to consider indirect incomes, forex fluctuation, profit of asset of that respective state or GSTN. This needs to be mapped with the trial balance as well as GSTR 9. Wherever there is a single registration, the turnover of the state must reconcile with the turnover disclosed in the audited financial statement, or the reasons whatsoever has to be there. In case if the differences leads to any additional liability, that has to be discharged. Now we have to be very careful where there are multiple registration. Now the turnover in a state must reconcile to the turnover as recorded in the books of accounts of each registration. Now when you are carrying out the GSTR 9C, kindly ensure the books of account for the respective registrations are being maintained at that location, number 1. Further, all the documentary evidences such as with regard to invoices, input, output, receipt voucher, payment voucher, self-invoicing, refund vouchers, all the documentary evidences such as LUT, registration certificate is being kept at that particular locations. Because in case if the departmental authorities comes for an audit, they call for the books of accounts and it has to be maintained at each of the additional place of businesses along with the principal place of business. Also ensure that the addresses captured in the registration certificate is up to date. Most of the times it may so happen that there is a change in the premises, however, it is not been reported in the GST registration by way of an amendment. So what would be the repercussions in case if it is not reported? Though it seems very silly, but mind you, whatever the invoices have been issued to the new location, which is not been added in the GST registration, the ITC on those invoices which is not a part of GST registration certificate will be denied. So kindly ensure the date when the amendment has been happened and also check for the invoices post and pre amendment so that appropriate actions can be taken. Now as we are aware that e-invoicing is applicable for most of the entities, and in case if the change in address is not intimated to the vendors, and if the vendor captures wrong address of the customer, then the ITC will be denied based on verification of the address as captured on the e-invoice when compared to GST registration of the recipient. So kindly ensure these are all small things but make a lot of difference. ITC is nothing but the cash. So any ITC which is been denied is a cash loss to the entity. Ensure optimization of ITC when you carry out the GST audit. Other important aspect in case of multiple registration is that kindly have reconciliation of turnover for the respective states and also a final reconciliation which will match to your audited financial statement so that any differences can be adjusted appropriately in the respective states. Otherwise, there will be a difference which will be reflected in the reconciliation statement, which will lead to demands. Now we move on to each line item, that is unbilled revenue. So what is this unbilled revenue? This unbilled revenue is a revenue recognized in the books before the issue of an invoice at the end of a particular period. So it is been there as a part of the accounting concept, that is matching concept. However, this unbilled revenue at the beginning of the financial year, in order to get these informations, we have to refer to the previous year audited financial statement or the financial statement of the previous year, which has been captured on a comparative statement. From there, we have to take this information. Now, unbilled revenue at the beginning of the year can be merged and disclosed in the table 5O, which is an optional thing. But however, it is always advisable not to exercise these options. Since it is only a one line items, it is better to disclose in the respective tables so that reconciliations becomes meaningful. The other aspect is value of all advances for which GST has been paid, but the same has not been recognized as revenue. The moment when we receive an advances without supply of goods or services, as far as financial statement is concerned, revenue will not be treated as earned, and it is recorded as a liability in the balance sheet at the end of the financial year. But however, from the GST perspective, the amount of tax would have been discharged on that and is a part of turnover. Where every registered person means every registered person is required to maintain a separate account of advances received, paid, and adjustment made thereto. See, I'm also referring to the books of accounts to be maintained wherever this relevant is there. I'm trying to stress upon that so that this becomes a part of your reconciliation statement and also the workings. So you need to have a working, whatever the amount has been received, out of that, how much of amount has been paid back without rendering the goods or services. Normally, it is by way of a refund voucher and the adjustment where invoices has been raised. So those detail has to be kept handy. Now, advances where GST is not payable need not be identified. Need to be identified, such as advances for goods or advances for exempted services, and only advances on which GST is liable should be considered for adjustment. Now, advance which are in the nature of financial transactions, sometimes there would be a loans. So these things are ignored because on these transactions, GST has not been paid. So therefore, there will not be any difference between financials and GST return. Now, report transactions which are not reported in the financial statement. So these are nothing but the branch transfers. So though the same are reported in the returns filed, now we'll continue with the same example. We have got a branch and HO at Karnataka, branch at Tamil Nadu. Now, in case if HO supplies goods to the branch for further sale, in those cases, as far as Karnataka is concerned, there would be an outward supply. Under VAT regime, it would have treated as a branch transfer, and there is no levy of tax in case if relevant forms are provided. The same is not continued under the GST regime. It will be treated as a supply, similar to a third-party transaction. But however, when consolidation of financial statement will happen, this will be knocked off. So therefore, identifying these transactions will become much more challenging. So for that purposes, one has to refer to the delivery challans maintained by the entity, stock inward, stock outward. Further, they have to refer to e-way bills. Most of the time, it may so happen that the reconciliation between e-way bill and purchase and sales are not being done. When you take out the e-way bill register from the portal or transaction from the portal, that will throw a lot of information so that appropriate queries can be posed to the assessee, and then the informations can be called for. So under these circumstances where there are branch transfer, kindly ensure that reconciliation between e-way bill, delivery challan is being made and appropriately disclosed in the respective returns. The branch will be able to claim the input tax credit provided the goods are taxable. In case of exempted goods, then ITC would be restricted. So kindly ensure that the HO has charged the taxes and branch has claimed the input tax credit. So it is a revenue neutral as far as entity as a whole is concerned. But however, on an individual basis, there would be a cash outflow will be there as far as branch is concerned. So kindly take into consideration. So any deemed supply, which is already a part of turnover in the audited annual financial statement, is not required to be included here. So basically these kind of transactions we don't come across. All these things, is not recorded. So therefore will have to be made a part of reconciliation statement. Now, transaction relating to stock transfer of goods, as I mentioned, it can be extracted from the delivery challan or on the analysis of e-way bill, whereas transaction of service transfer will be based on understanding of the nature of business. So I would like to give a couple of instances. Continuing with the same example, when a HO is rendering accounting services to the branch office or manpower services or HR services, or it may be IT infrastructure or other support services. Under these circumstances, where the transaction of the entity are not taxable, that means to say that if those transactions are exempted, now to give a simple example in case of hospitals, so any services rendered by an hospital to the patients are exempted. So under those circumstances, whatever the ITC is there, it will be subjected to valuation. So we have to refer to section 15 and respective rules where the valuation has to be carried out and the transactions will be recorded based on the valuations. So you have, though from the accounting perspective or income tax perspective, these transactions are not recorded, but from the GST perspective, it becomes relevant. Now take another scenarios. You have to take into consideration the nature of business carried out by the branch office. In majority of the cases, what will happen is the branches will have the employees, they have got the infrastructure, but however, invoices are not raised from the branches. All the invoices will be raised by the HO itself. Continuing with the same example, HO is in Karnataka, branch office is in Tamil Nadu. They have got an employees for the purpose of software development. They have got a office place. They have got a registration. They are incurring expenditure in Tamil Nadu. But however, there are no outward supply as far as Tamil Nadu is concerned. So these are the instances wherein you need to inquire why outward supply is not being carried out by the entity at a branch level. So this will enable you to questions, is there a cross charge which has to be adopted here, or is there a possibility of ISD, that is input service distributors? It is only with regard to services where HO receives the services and these services are consumed by the branch level or the manufacturing unit. So the ITC has to be transferred. So for that purposes, the HO needs to have a separate registration, that is ISD registration, and they have to raise ISD invoices, and the branch has to claim the ITC based on the ISD transaction. So we have to take into consideration, is cross charge applicable, or are there any ISD transactions which has to be given effect? Are they complying with the ISD provisions, that is input service distributor provisions, or a cross charge provisions? And this becomes more relevant where the entity is into both taxable as well as exempted services. Even if it is a part of the transaction is exempted, it is very, very important for us to take into consideration the valuations. Otherwise, at least the risk is minimum, because it is a revenue neutral, and we can even take the benefit of this circular, which states that in case if the entity is able to take the full input tax credit, whatever the value adopted by the HO to the branch or vice versa can be taken as the base for the purpose of GST. And even in case if no invoices is been raised, it will be treated as a zero. At least there is a cover as far as taxable transactions are concerned. But when it comes to the exempted turnover or a part of the exempted turnover, we have to be very careful, because this will vitiate the disclosure what has already been done. So there would be an additional liability on account of reversal of ITC or blocked credit. Now, basically, when we refer to the transaction between the entities, that is between distinct entities, always we come across improper or incorrect valuation of the supplies made without consideration. So we have to take into consideration the valuation provisions. Another aspect is that they don't recognize the deemed supply of services between distinct persons. Now the department, invariably when they take up the case for audit, they will ensure that these transactions are being subjected to tax. They call for all the informations. So therefore, we have to be careful as far as these deemed supply of services are concerned. Sometimes it may so happen that the management is sitting only in Karnataka, and however, they are overseeing the functions of the branches. So the department may allocate the cost of management, which is very, very huge. And in those cases, in case if cross charge is not done, then it will lead to a catastrophe at a later point in time, along with tax liability, interest, and penalty. So we have to be very mindful as far as these distinct entities are concerned. Have a thorough checklist, discuss with the appropriate person, ensure that if there are any cross charge, means cross services, these has to be taken into consideration. As I mentioned, most of the cases, the branches doesn't record any outward supply because they are still following the old age regime, what was existing under the service tax regime, that is under the centralized registration. There is no concept called centralized registration under the GST law. So therefore, each transaction has to be evaluated independently, irrespective of the related parties. They may be belonging to the same party, but however, in the eyes of the GST law, they are two distinct entities, and it becomes much more critical in case if the transactions are pertaining to exempted turnover. Many a times it may so happen that in case of works contract or in case of other entities, they move the capital goods from one entity to another entity based on the delivery challan. And the goods are permanently stationed in the other location. These are all subjected to GST. So kindly ensure that in case if it is being transferred, even for temporary purposes also, it will invite the taxes until and unless it is for some other reasons other than for supply. For example, testing or for exhibitions. In those cases, there may not be any liability. But however, in all other circumstances, it will be subjected to tax. So they have to take into consideration these aspects into consideration. Now moving on to table 5, that is pertaining to credit notes which are issued after 31st of March for any supply accounted in the current financial year. But such credit notes were reflected in the annual return in Form GSTR 9. See, what we are trying to look into these tables is that the difference between financial turnover and GST turnover and reconciling those things. It is similar to the bank reconciliation statement, what we normally use to prepare. However, these transactions are very rare in nature. Normally, these kind of situations will not be there. Now moving on to the next line items. In case where a financial credit note is issued by a supplier, it would not adjust turnover of the, it would adjust the turnover of the original supply, but recorded in the books of account. But however, such credit note would not be declared in the return under the GST. So what does it mean? Now take a scenario that the goods or services has been supplied, but however, at a later point in time, it is found that there is a defect and the period of specified or the specified period has elapsed. Under those circumstances, you can't, raise a credit note. So you have to raise a financial credit note in order to square off the transaction or make an adjustment in the payable receivable transaction. So these transactions, though it will have an implications from the financial statement point of view, but from the GST, no benefit of reduction in outward supply or taxes has been claimed. So therefore, this has to be disclosed separately. So the another item is discount offered post supply. As far as GST is concerned, whatever the discount you are providing, it has to be disclosed on the face of the invoices. Then you are eligible to claim the benefit of reduction in value of supply. There is also another scenario where there is an agreement between the buyer and the seller that based on the achievement of the turnover, there is a specific percentage of discount which will be offered for a specified period. If there is any such agreement well in advance and post the reaching of such an event, if discount is being allowed, so that will be taken into consideration and benefit will be given. But if no such agreement is existing, then in that case, any discount offered post supply will not be eligible to claim reduction in the output tax liability. So we have to take into consideration the agreement if there is anything of such kind is existing. The reason being is that all these benefit can be claimed only when there are specific provisions incorporated in the agreement. If there are no specific provisions in the agreement, then you cannot take the benefit of it. Similarly, you have to take into consideration the communications between both the parties. This we will come across where there is a wholesaler or there is a supply with regard to mobiles, where there are special discounts which have been offered based on the turnover achieved or the quantity lifted during a specified period. So those schemes has to be looked into and respective treatment has to be given effect to. Now table 5K is with regard to SEZ unit. Normally when SEZ unit supply goods to a DTA unit, the bill of entry will be filed by the DTA unit. So this transaction would not be considered for the purpose of GST as far as SEZ is concerned. So therefore, this amount has to be disclosed separately so that we will be able to arrive at the differences. As far as DTA is concerned, this transaction would be treated as import of goods. Now coming to 5L, there may be cases where registered persons might have opted to composition scheme. Many a times what happens, composition dealer may switch to normal or regular taxpayer. Under these circumstances, the turnover has to be separately disclosed. And in case if they are subjected to GSTR 99C, so both annual return for regular dealer as well as composition dealer has to be filed. So this has to be taken into consideration and that turnover will be disclosed in 5L. There may be cases where taxable value and invoice value differ. It is because of the valuation principle. Now, as I mentioned that the entities might be supplying the goods at a nominal value, because in case if they subject the transaction at the full value, it will lead to GST output liability. So therefore, sometimes they resort to nominal value. And under these circumstances, if the transaction is between related party, it will be subjected to valuation. Therefore, the turnover as per financials and turnover as per GST would differ. So any such transaction needs to be reported under this table. Now, exchange rate differences is a normal phenomena when there is a transaction between overseas entities. So either there may be a parent entity and Indian entity may be supplying goods or services. Because of the exchange fluctuation, the amount will be accounted in the books of accounts. So either it may be a gain or it may be a loss. So any such amount received forms part of the profit and loss account and it is not a part of GST return. So it is because of the purely accounting concept and does not form part of the GST return. Hence, there is no requirement of revision is required as far as GST returns are concerned with respect to exchange fluctuation. Very often we come across that an entity carries out the transactions on behalf of their customer and normally term it as a reimbursement of expenses or out-of-pocket expenses. They also even contend that there is no value additions on the transaction, but however, in order to act as a pure agency, there are specific conditions which needs to be fulfilled. And only when those conditions are fulfilled, this transaction will be outside the GST net. Otherwise, this transaction will be subjected to GST. So what are those conditions? There should be an agreement. Along with the invoices, the recovery of the out-of-pocket expenses also should be made a part of that invoices. The invoices should be in the name of the respective party. The supplier is only a means by which the payment is made to the service recipient on behalf of the customer, and the goods or services should also be received by the customer and not by the supplier of goods or services. Only when these conditions are fulfilled, then in that cases, it will be treated as pure agent and the transactions can be kept outside the GST net. Many times it may so happen that just because there is no profit element and the cost is recovered, they try to keep outside the GST net without fulfilling the conditions of pure agency as per Rule 33. So ensure that the conditions, what has been envisaged in the rules are being fulfilled. Only after that, the benefit of GST can be availed. Otherwise, there is an exposure. Now, all these items will be disclosed under Table 5.0. Sale of capital goods. In financial statement, we only record the profit or loss on sale of capital goods. But however, as far as GST, the transaction, full value of the transaction, that is the sale consideration, will be recorded. So therefore, because of which there will be a differences. So kindly ensure you need to review the audited financial statement. Before you carry out the GSTR 9 and 9C, kindly review the financial statement because it will throw most of the informations when you review the audited financial statement. Point number one is you should not only stress upon the profit and loss account, but also the balance sheet item, notes to account, cash flow statement, because many of the informations are available in these schedules, notes, which can be used for the purpose of correct filing of GSTR 9(9)C. To give a couple of instances is sale of capital goods, it will be a part of cash flow statement. Sale of mutual funds. Transactions in foreign currency, either it may be a export or it may be a transactions with related party, that is directors, or it may be transactions with parent entities. Transaction in foreign expenditures. Ultimately, this has to be taken into consideration for reconciliation of our RCM liability. Take into consideration the financial audited financial statement such as advances, balance sheet advances received from customer particularly with regard to services, whether the transaction is subjected to GST or not, have reconciliations on that. Then verify the payments to vendors outstanding more than 180 days time. There is a liability because ITC which has been availed has to be reversed along with interest. And once when the payment is being made to the vendors, there is no time limit for availing the ITC. So all these information will be, taken into consideration even without going into the workings. So kindly make note of all these items. Another important aspect is with regard to, debtors, particularly with regard to exports, where the outstanding amount is more than 1 year. Kindly raise a red flag. And in case if the realization is beyond 1 year, point number one, you have to intimate the management that there is a liability, inherent liability on the transaction for non-recovery of foreign currency. What has been treated as a zero-rated supply will be subjected to GST at the rate of 18% along with interest, and interest will be a cost. In case if the amount is received subsequently, within 3 months, you can file a refund application and claim the refund of the taxes what has been paid. But however, it will have a implications on the cash flow because most of them, depend on the foreign parent entity wherever there is a transfer pricing agreement. They don't have any revenue apart from depending on the parent entity. And interest will be at the rate of 18%, which is also a very huge. Further, all the transactions where there is a non-compliance, you cannot take the benefit of LUT. The transaction will be subjected to GST at the rate of 18%. So this has to be communicated to the management very clearly in the first instance itself. Now take another scenario, input and capital goods sent to job worker, but is not returned within the prescribed period of 1 year or 3 years as the case may be. In those cases, though from the audited financial statement point of view, it is not a turnover, from the GST, there is a specific time period. And if the input and capital goods is not received by the principal from the job worker place, it will be treated as supply on the date on which the initial input or capital goods has been sent to the job worker. And interest needs to be computed from the date of the goods sent to the job worker. Now, goods sent on approval basis. Many times it may so happen that the daily items such as curds or batter, which is produced on a daily basis, these goods are sent to many of the shops on an approval basis. That means to say that only when they sell it, they will be the vendor will be able to raise the invoices. So there are certain cases, if it is not a perishable goods, where the shelf life is more than 6 months, it might be lying with the service recipient or the customer or the wholesaler. We have to ensure that either the goods are received back within 6 months or else the invoices has to be raised. And in case if it is beyond 6 months, invoices will be raised on the date when the goods have been sent on approval basis. So there is an interest implications which has also needs to be taken into consideration. The result of all such adjustment in the revenue is annual turnover after adjustment. So which would be an auto-populated. Now the moment when we get these turnover, it has to be compared with the turnover as per GSTR 9. So table number N figure has to be taken in table 5Q, and the resultant figure might be a positive or a negative.
Most working professionals will hate me for saying this, but Google Sheets is the worst tool to use and doesn't even have 20% of the functions Microsoft Excel has. And now you can integrate ChatGPT and AI tools inside Microsoft Excel to write 174 Excel formulas without having to remember any of it. You can now create all your Excel reports in less than 60 seconds. You can automate your work by creating your own macros in Excel without coding knowledge and do a lot more things that used to take you hours in just a few seconds. If you want to integrate ChatGPT and AI in your Microsoft Excel, I invite you to join me in my certified 3-hour ChatGPT in Advanced Excel workshop. Hi, my name is Jatan Shah. I'm a Microsoft certified official trainer and an Excel expert. In this workshop, you will learn how to use ChatGPT and AI in Microsoft Excel to write formulas, create reports, analyze data, and automate your work to work 10 times faster.
In case if there is any differences, now we need to provide the reasons. I would like to stress upon the erstwhile regime, how difficult it was for the assessing officer, to carry out an audit. Whenever they find there was a VAT 240 audit report, where though the differences was there, but on what account they were not able to understand it. So because of the lacuna or the flaws in the previous regime, GST law has come out with the differences, whatever the differences, it may be on account of turnover or it may be on account of ITC. The reasoning has to be provided in the reconciliation statement itself, so that the officer will be able to consider without the representation by the assessee. So kindly ensure, in case if there are any differences, it is appropriately worded so that the other person is able to understand. Now, on what account there would be a difference in this? So transaction reported in delivery challan, that is during a financial year for supply on sale on approval basis beyond a period of 6 months, shall be deemed to be supply under GST. However, there will not be any revenue recognized in the books of account. So these are the reasoning which has to be provided in the reasons, and you can add the number of reasons in the reconciliation statement. In the previous table, what we have done is we have compared the turnover of audited financial statement with the GSTR 9 turnover, that is on a gross basis. Now that turnover also includes exempted, nil rated, non-GST turnover or no supply turnover, or zero rated supply without payment of tax, or supply on which tax is to be paid by the recipient on RCM. So these are the transactions which has to be removed in order to arrive at the taxable turnover. Why we need to arrive at the taxable turnover? The reason being is that we need to compute the tax liability based on the reconciliation statement. So therefore, we start with annual turnover after adjustment, which is from the previous table, which is auto-populated. Now, we have to deduct the value of exempted, nil-rated, non-taxable supply and non-supply turnover from the annual turnover after adjustment to arrive at the taxable turnover. So essentially, 7B comprises of four supplies. One is supplies taxable at nil rate of tax, supplies that are wholly or partially exempted from tax, non-taxable supplies such as alcoholic liquor for human consumption, petroleum product, or no supply as per Schedule 3. All these transactions has to be reported in Table 7B. Now, as far as 7C is concerned, it is zero-rated supply without payment of tax. Either it may be export or SEZ. Those transactions has to be reported in Table 7C. 7D is very, very important. Now, where the supplier is supplying goods or services, the tax on which is liable to be paid by the recipient, then such supply would be treated as exempted. Most of the time, it may so happen that GTA services, when they are charging 5% without ITC, where the tax is paid by the companies who are registered. So those transactions will be covered under this. Now, what is the implication of 7D? The moment when any transaction is reported here, that means to say that it is an exempt supply. The moment when it is an exempt supply, you need to take into consideration the reversal of ITC as per Rule 42-43. So whenever you come across in this table, verify whether sale is also been made or not. So the data entered under 7D is supplies made by the supplier on which tax is to be paid by the recipient. One of the example is advocate. When they disclose in 7D, it is the company who pays the tax on the advocate services. So for the advocate, it is an exempted supply. For the company, it is an RCM liability. Similarly, there is a GTA, is neither charging GST nor availing ITC, and GST is payable by the recipient under reverse charge. That is when GTA services is rendered to the company. Then the said turnover would come under this entry. Another scenario is services provided in the capacity of a director to a body corporate. So under these circumstances, in the returns of the director, it is reported under 7D, and the company will pay tax on the RCM basis. So once when you find an entry under Table 7D, kindly ensure that Rule 42-43 has been computed. Many times it may so happen that Rule 42-43 has to be computed not only on the monthly basis but also on the yearly basis. But yearly basis it is missed out. Kindly ensure that you take note of computations on an overall yearly basis also and find out any excess or short is there. So Table 7F will be a taxable turnover. So this has to be compared with the turnover as reported in GSTR 9. So there it is 4N minus 4G plus 10 plus minus 11. You take into consideration the transaction that has happened post the financial year, that is transactions which are reported up to the specified period. Now, any differences, we need to give the reasons for the differences. So as I mentioned, these transactions with regard to sale on approval basis is one of the example. So on this account, there might be a differences in this turnover.
Dreamers and doers, aspiring independent directors. We've got a game-changing revelation that's about to turn the tables. A breakthrough in Section 149 of the Companies Act 2013, MCA and SEBI have mandated that 1/3 of the board for listed entities must consist of independent directors. But why is this earth-shaking? And who stands to gain? Picture this. Every listed Indian company is now scouting for independent directors, and not just a token presence, but at least 1/3 of the board. That's an opportunity highway for a whooping 37,000 competent professionals. And guess what? There are only 11,000 certified independent directors available. Talk about a delicious demand-supply gap. But here's the kicker. India boasts an untapped pool of senior leaders brimming with potential to fill this gap. The catch? They either lack the roadmap to the boardroom, don't hold the required certification, or simply don't realize that this golden ticket can be earned by investing just a couple of weeks of their time. So, to you ambitious professionals, we invite you on a journey of exploration into the uncharted cosmos of independent directors. Dedicate just an hour of your time to this exclusive webinar. Rub shoulders with creme de la creme of the industry, and we guarantee it will be one of the most enriching experiences you've ever had. Ladies and gentlemen, I am thrilled to invite you to register using the link below, and we can't wait to welcome you to our transformative webinar.
हेयर फॉल शैम्पू, हेयर फॉल ऑयल, 10 दिन तेल लगाओ, बाल उगाओ. Entire industry has giving products that don't work. हेयर फॉलिकल होता है, अब उसमें बाल झड़ गया है. हाँ. बहुत सालों तक अगर उसको ट्रीट ना करो वो सील हो जाता है. ऑलमोस्ट लाइक अगर एक प्लांट सूख के मर गया, फिर आप उसको कितना भी ट्रीट करो, पानी डालो, वो रीग्रो नहीं होता है. वैसे ये सील्ड फॉलिकल को रीग्रो नहीं कर पाता है. यंग हो और आपकी स्टेज 1 to 5 है तो बहुत अच्छे से रिवर्स हो सकता है. 6-7 डेंजर जोन है. 40 के नीचे बहुत अच्छे रिजल्ट्स आते हैं. 40 के ऊपर टफ हो जाता है. हमारे फेवरेट कस्टमर्स आर पीपल इन देयर 20s बिकॉज हमको पता है उनकी बॉडी रीजनरेटिव स्टेट में है. एक्चुअली ऐसी चीज है कि आप जितना जल्दी उस पर एक्ट कर लो और जितना जल्दी कुछ एफिकेशियस ट्रीटमेंट स्टार्ट करो तो इट्स वेरी इजी टू लाइक पॉज एंड स्टॉप इट वेयर इट इज. त्राया में एक ऑनलाइन हेयर टेस्ट रखा है जिसमें हम आइडेंटिफाई कर लेते कि ये बंदे को कब से हेयर लॉस.
Now, we have first compared the total turnover with the total turnover of GSTR 9. Then we arrived at the taxable turnover compared with GSTR 9. Once the taxable turnover is arrived at, now we need to do the reconciliation of the liability. And this has to be done on a rate-wise. It is always important for us, to have appropriate outward register with all the fields. Take into consideration the rate of taxes, also interstate, intrastate, have a validation check, reverse charge liabilities, and also take into consideration the HSN. Most of the time, may so happen that the entities will not do a thorough check about the HSN, what they are capturing. The HSN and SSC code and the rate what they are capturing are two different things. So on a test check basis, it has to be reviewed. In case of services, not many items will be there, but in case of goods, lot of effort is undergone, in verification of rate, because sometimes rate may change. To give a couple of examples, cattle freight is subjected to tax. The classification has to be taken into consideration. Also, the notification has to be given effect to. And are there any lab tests? Because sometimes they may treat it as a residue and subject it to tax. However, the cattle field per se, if it is classified under that category, can be claimed as an exemption. But it all depends upon the category of goods. Further, in case if any brand is being used, it will be subjected to tax. So all those things has to be considered. Not only that, you need to take into consideration the interest, late fee, penalty. Normally, this penalty may not be there until and unless if there is a visit inspections wherein they levy the penalty. Otherwise, there may not be any penalty. And this has to be compared with annual return, taxes paid under the annual return. And if any differences are there, we have to give the reasons for differences. So here we are comparing the taxes as is computed based on the 9C on the taxable turnover with the taxes paid under GSTR 9. So here we need to take into consideration, as far as GSTR 9 is concerned, if any differential tax is being paid as per table 10 and 11, even that also needs to be considered. So as I mentioned, we need to give the reasons for differences. Now, when we do the comparison, there might be an additional payout which has not been paid in GSTR 9. So this additional liability has to be captured rate-wise. This will enable you to compute the correct outstanding liability. Also, you need to take into consideration the interest in case if there are any delay in filing the returns. Of course, now you are not even eligible to file the subsequent returns without filing the previous return. So therefore, this may not be a relevant thing. But however, if there are any delay, in those cases, interest also needs to be taken into consideration, and this liability has to be discharged. So the registered person is required to pay the additional tax liability. Further, there are chances that the taxes might have been paid, in excess. Under these circumstances, appropriate disclosure will enable the assessee to make a claim and file the refund application before the authorities, excess paid under other categories. So therefore, GSTR 9 plays a very prominent importance for the reason that if any excess payment has been paid and if it has been captured in GSTR 9C, it will also become a documentary evidences to file the refund claim, which can be substantiated with GSTR 9C because it is a reconciliation statement. If it is missed out, then it becomes very difficult to make a claim because the GSTR 9C may not have a relevant observations with regard to excess payment of taxes. Then in that case, the department may not sanction the refund.
Ever wished you had a magic lamp that could make all your wishes come true? Now, unlike Aladdin, you don't need a magic lamp. Imagine all your wishes just coming true one after the other. It is possible, and with my 90-minute fantastic scientific manifestation masterclass, you can become the genie of your own fortune. Hey, I'm Ankit Nirav, life coach and peak performance expert. I have trained over 1 lakh people the science behind manifestation and start using law of attraction. So, if you're interested in unleashing your inner genie to manifest your dream life, I want to invite you to my 90-minute free scientific manifestation masterclass. Click the button below and join in right now. I'll see you inside.
If you are running a business where you are the one who's managing operations, sales, marketing, finances, hiring, and everything else, then let me tell you something. You're not really running a business. Your business is making you run because you've set yourself in a trap called the trap of self-employment. Self-employment is a situation where you start a business, you create jobs, you pay salaries to your team members on time, but you end up doing the work that your team is supposed to do. And in such a trap, it's very common for the business owner to not pay himself or herself consistently, because you pay yourself only when there is money left, if there is money left. Now, if as a business owner, you're stuck in this trap and you're serious about breaking through this trap and build a business in a manner where you are not stuck in day-to-day firefighting and you can focus on growth and expansion, then I invite you to be a participant at my 3-hour training called the Business Success Workshop, where I will teach you how to go about building a business in a manner where you have strategies, systems and teams in every single department, so you have the time and energy to focus on growth and expansion. And all of this for just an investment of rupees 99. Hi, my name is Rajiv Talreja, and as an educator for the last 17 years and as a business coach for the last 7 years, I've helped more than 25,000 business owners set up strategies and systems in their business in a manner where it can grow without them. And I myself have built 4 businesses and own 1 celebrity sports team. So I want you to be a part of this learning journey so I can help you structure your business in a manner where you play the game of growth and expansion and get out of the trap of firefighting. So register yourself right now for the Business Success Workshop. More than 1,82,000 business owners have participated in the Business Success Workshop and have given us a rating of 4.8 out of 5. So you cannot miss this opportunity. Click on the link, register yourself. On completion of your registration and completing the training, I will also be giving you bonuses worth.
Up to the previous table, we have computed we have made the comparison between the financial statement turnover with GSTR 9 on a gross level. Further, we have done the comparison of taxable turnover and taxes paid as per financials, as per GSTR 9C and the financial this thing 9. Now we move on to the reconciliation of net input tax credit. So when it comes to the input tax credit, it is a normal phenomena that the ITC might be booked in the earlier financial year, but it has been claimed in the current financial year in the annual returns, GST returns, or it may be booked in the current year, but it will be claimed in the subsequent financial year. So these are the reasons because of which there will be a differences in ITC. So once when you do this comparison, you have to compare with the annual return. Kindly also ensure that you do this comparison with electronic credit ledger. The reason being is that ultimately whatever is reflecting in the electronic credit ledger should be reflected in the audited financial statement. Many a times there is no mechanism of reconciliations year to date, because of which there are differences. And these differences, the moment when you don't reconcile at any particular point in time, so over a period of time, there would be a very huge reconciliation, and because of which there might be a probability of raising demand by the department. Kindly ensure your electronic credit ledger balance is mapped with books of accounts and any reconciliation is adjusted appropriately. Similarly, electronic cash ledger also is been reconciled. Entities have to internally derive their ITC for each individual GST and declare the same year. It is not on a consolidated basis, it is based on the GST wise. This information has to be reported. Here we normally face challenges in case the books of account is not maintained on a branch level wise. Many a times the accounting team segregate the ITC based on the vendor, taking into consideration the invoices, physical copy or the address captured on the invoices. Therefore, it is always important to ensure that appropriate working is being maintained by the assessee, and you take those working before you start compiling the information for GSTR 99C.
If you're someone who procrastinates a lot, no matter how hard you try, but you cannot get things done, then listen to me for the next 1 minute. I'm going to share with you the 3 most important things about procrastination that nobody else will tell you. Procrastination is not your fault. You heard it right. Procrastination is just a symptom. It is not actually the cause. And it's a symptom.
When we were referring to the audited financial statement, as you are aware that audited financial statement is based on the PAN basis. Now, what are we referring to under these circumstances? Because we don't get that figure from the audited financial statement. So under that circumstances, it means or it implies to the books of accounts. We are comparing with the books of account in case where the entity is having multiple GSTN. Now the net ITC available for utilization should be compared as declared in table 7J of the annual return. Now 12F of form 9C provides for the difference between ITC as computed from books of account and ITC as claimed for the financial year in the annual return. It is not always that the shortage on account of outward supply, there is a tax liability. There can also be a tax liability because of differences in ITC between the books of account and annual return. In case if there is any excess claimed in GSTR return, that needs to be reversed or it has to be paid in case if there is no ITC available. So the demand or the tax liability can be on account of outward supply, shortage in outward supply, or it may be on account of excess claim of ITC or ineligible ITC claimed in the returns. Now coming to the differences. So these differences, as I mentioned, in case if the difference is positive, that might be because of ineligible ITC not availed in the returns, or ITC which has lapsed has not been availed. Now in case if there is a negative, it is a duplicate ITC, means we have claimed more ITC when compared to books of accounts, or ITC of the subsequent year when goods or services were received later, but their invoice was received prior was availed. Just to give an example, now on 28th of March, I have received an invoice, and this invoice has been raised by one of the vendor who is in the state of Delhi, and the goods is moving from Delhi to Karnataka. It is in transit. Based on the invoices, I would have taken the ITC in my GSTR 3B, but actually I am supposed to take the ITC in the return only on the receipt of goods. One of the conditions for availing ITC is I have to receive the goods or receive the services only on the receipt of goods or services along with invoices. I am eligible to claim the ITC. So we have to take into consideration these aspects and then give appropriate treatment. Though this is optional, but however, it will throw a lot of informations to the GST authorities, particularly when they take into consideration, say, for example, column number E. If any expenditure is there on account of insurance, for example, employee insurance, ITC is blocked, or insurance on vehicle, ITC is blocked, or goods lost, stolen, destroyed, written off, disposed of as a gift or free sample, ITC is restricted. Or it may be with regard to entertainment charges, where it includes staff welfare or expenditure incurred on account of annual gathering where it is not in furtherance to the business. So the department will be able to identify the expenditure on which ITC is restricted or blocked and then compute whatever is the eligible ITC. Hence, this becomes very important. Now coming to column number M, repairs and maintenance. It may so happen that the entity might have incurred expenditure on account of vehicles, which is restricted, or some of the items might be mentioned under miscellaneous items. So the list, what has been given here is only an indicative list. The assessee is having an option to add on the expenditures, relevant expenditure here. Even column number O, on account of capital goods, for example, you may have incurred expenditure for the purpose of addition to the factory building or without the civil works for the installation of the machinery. Only in case of civil work for the installation of the machinery is allowed as an input tax credit. All other expenditure on civil work is restricted. So once when the authorities verify the expenditure, they will come to know the eligibility or ineligibility of the ITC or a block credit. And accordingly, they want to verify the books of accounts and returns and ensure that no ineligible ITC is claimed. Ultimately, whatever is the eligible ITC is there, that eligible ITC will be compared with ITC claimed in annual return. And any differences, it has to be explained in the next table. So this table is for reconciliation of ITC declared in the annual return against expenses booked in the audited financial statement or a books of account. So various subheads specified under this table are general expenditure in the audited financial statement or books of account on which ITC may or may not be available. So there may be an expenditure there, but ITC is not claimed. Then you need not disclose in that particular item. Only when ITC is claimed, then disclosure is relevant. So further, this is only an indicative list, as I mentioned. You can add the add or delete any of these items. And table 7J of the annual return is taken into consideration for filing this table. Now, this point requires detailed examination of books of account to establish that registered person has taken only eligible ITC. Now, when you categorize the expenditure, will come to know whether ITC is eligible or not. So this will facilitate the auditors or the consultant who is carrying out the GSTR 9C for the purpose of eligibility or ineligibility of the ITC. So even though it is optional, kindly ensure that in case if the information can be collected, kindly provide the same. The reason for differences is the beauty of this reconciliation statement. Even though the person is not involved with the GSTR 9C, he will be able to identify on what account these differences are there. Only condition is that it should be appropriately worded so that it will give the essence of these differences. Sometimes the reasons are very vague. It is always better to give a detailed reasoning for differences in reconciliation and appropriate actions also. Now, difference can arise on account of any of the following reasons. One is ineligible ITC availed by the registered person. Now we move on to the next table, that is table 16. Tax payable on unreconciled difference in ITC. As I mentioned that it is not only on account of outward liability, but also on account of ITC also there will be a liability which will be arising. Now that needs to be paid in this table. So amount payable due to reasons specified in table 13 and 15 above shall be declared here. And table also demands computation of interest. So penalty, normally there will not be any penalty until and unless there is any inspection.
Most working professionals will hate me for saying this, but Google Sheets the worst tool to use and doesn't even have 20% of the functions Microsoft Excel has. And now you can
because if you are making a voluntary payment and it is being informed to the authority, there will not be any penalty. And penalty, there should be a show cause notice. Only after that they can invoke the penalty. Now, any additional liability due to non-reconciliation, first it has to be computed rate-wise. This table also includes both outward as well as liability on account of input tax credit, interest, and other items. So there might be a situation, for example, in case if the assessee has received the refund on account of export of goods. Now, one of the conditions for export of goods is that the goods should be taken out of India. Point number one. Point number two is that they have to receive the foreign realization within 3 months. In case if the amount is not received, then the department may recover that amount. And if the consultant identifies these things, so it is a kind of an erroneous refund which has to be paid back. Now, outstanding demands to be settled. So all those items will be covered in this table. So table 5 consists of additional liability to be discharged by the taxpayer due to non-reconciliation of the turnover or non-reconciliation of the input tax credit. So any refund which has been erroneously taken and shall be paid back to the government shall also be declared in this table. So this is very important. Now, in case if there is any liability, the taxpayer has an option to pay this additional liability by way of DRC03. Taxpayer can select reconciliation statement in the drop-down menu while filing DRC03. And the liability has to be paid only through electronic cash ledger. If any liability is there, it has to be paid through electronic cash ledger, barring few cases where it can be utilized by way of input tax credit. So with this, we conclude the GSTR 9C.